Коллеги,
Good morning, dear colleagues. Let us get started. Those who are drinking coffee, please take it into this hall and we will start our conference. Good morning, dear guests, dear participants of the conference, dear colleagues. I'm pleased to welcome you at the Scientific and Practical Conference of the National Bank called Monetary Policy and Financial Stability Amid Global and Domestic Shocks. This is our fifth scientific and practical conference. At the same time, for 3 years in a row, we have been gathering in this hall, which is already acquiring an element of tradition, together annually in the spring in the center of Almaty to share the results of our work, discuss the research of invited speakers, exchange experience in modeling and forecasting, analyze previous shocks and current challenges. The experience of past years has shown the effectiveness of the conference as a successful format of interaction with the academic and expert community. In the current unstable times, scientific research and studies are especially relevant. It is important not only to discuss and analyze what is happening, but also to look for innovative approaches for solving old problems and new challenges. This specific approach can be characterized by a quote by Nelson Mandela: "Everything always seems impossible until it is done." This means that even the most difficult tasks become feasible with systematic analysis and persistent search for solutions. I think we will see this approach reflected in the speeches of today's conference participants. Over the past term, the conference has secured its international status. Today, we are pleased to welcome our colleagues from Azerbaijan and Uzbekistan to share their scientific research in the field of monetary policy. This is very valuable as it enriches our discussion with a variety of approaches and practical cases, contributes to strengthening regional scientific dialogue, and develops international cooperation in research activities. Considering that the researchers from different countries have been invited, the papers will be discussed in 2 languages, but we can discuss the most current trends in the economic situation and the tasks facing the regulator in 3 languages: Kazakh, English, and Russian. Friends, I hope that the discussion will be fruitful and interesting, and I encourage our guests to be active, ask questions, comment. After all, it is the lively exchange of opinions that makes the discussion truly valuable. We have 2 options to support the discussions: to ask a question or express your opinion. You can use the microphone in the hall. You should approach it during the question and answer session. The second option is to use your smartphones to scan the QR code, which is located in our pages on the screen, and in the application that opens, you can ask your questions to the speakers. The event program is based on the relevance of issues of monetary policy and financial stability and is divided into 3 sessions. 2 sessions before lunch and 1 session after lunch. Our first session is regional challenges in monetary policy. Research in this area is more relevant than ever in the context of domestic and external instability. Volatility in global commodity prices, structural reforms, supply chain disruptions, and changes in consumer demand patterns are just some of the challenges facing central banks. Modern economic realities require take into account many factors when making decisions, from the international situation to the specific domestic demand. Therefore, the central bank researchers pay special attention to studying the effect of monetary policy measures on the dynamics of domestic prices. No less useful for the regulator is the analysis of consumer patterns in connection with financial stability, which is the subject of our second session. Crises change household behavior, whether it is a pandemic lockdown or changes in domestic market conditions. Central banks take into account changes in the global economy to development of e-commerce and the transformation of consumer preferences in their activities. Analyzing consumer behavior will help us assess its impact on the economy and take the necessary measures to prevent deep economic failures in the future. I'm sure that the morning sessions will generate lively discussions, which will require a lot of energy, both physical and mental. I hope that we will have enough energy for the afternoon part of the conference. Therefore, anticipating the events, I would like to announce the program in a little more detail in advance and urge participants to not to disperse after lunch, since the afternoon session will be very important and it will examine equally interesting topics. At the third session, macroeconomic dynamics in the context of price shocks and structural imbalances, colleagues will present very relevant research of Kazakhstan. After all, everyone is curious about whether oil prices affect business cycles, whether there is a compromise between government spending and accumulation of public debt, how effective is business. Dear guests, I'm thankful to all of you for finding time and paying attention to our conference. The interest shown in this event speaks to the relevance of the topics under consideration. Once again, I would like to say thank you to everyone being present here today and speakers. Your interest in the conference and willingness to share your research results inspiring motivates us to contribute to constructive dialogue and leaves hope for a meeting next year. Thank you for your attention. Thank you, Vitaly Alexeyevich. Dear participants, the fifth Scientific and Practical Conference is started. Our first session is starting. Our first moderator of the first session is going to be introduced to you now. The first moderator is Jandos Ibraev, holds a PhD in economics from the University of Massachusetts Amherst. He has been working in the National Bank of Kazakhstan since 2020, currently holding the position of Deputy Director of the Financial Stability Research Department. His research interests include the interaction of monetary policy with financial markets, fiscal policy, macroprudential regulation, and long-term economic growth. His research papers have been published in journals such as the International Review of Applied Economics, Comparative Economic Studies, Journal of Banking Regulation, and others. Dear colleagues, we are starting our first session, regulation of the monetary policy, to understand how the countries are responding to the internal external shocks follow the exchange rates and capital flows. We will see the three works respective presentation of the situations in the local market. Republic of Azerbaijan representative, please, the floor is yours. I would like to join the words of Vitaly Alexeyevich. Please feel free to ask questions. It will help all of us. I would like to introduce to you all the president, the team of the National Bank, three people. Adam Zhuzbayev, head of the Monetary Analysis and Financial Credit Policy Department. Adam Zhuzbayev was responsible for introduction of the base rate model. His research covers a wide range of research topics, from assessment of fiscal policy to analysis of the consumer demand and structural modeling. Baurjan Shamar, the chief specialist of the Monetary Credit Policy Department, participates in all analytical and research works of the National Bank, with a significant contribution into development of the monetary policy development until 2030. Among his interests, analysis of the cash mass transmission channels of monetary and credit policy. Zhibek Tulegenova, lead specialist, analyst of the Department of Monetary and Credit Policy, specializing in transmission mechanism of the monetary and credit policy and functioning of the credit market. Her analytical sphere of work includes preparation of review analytical materials in the decision-making process for the base rate.
Timurberk Baymurzaev. He's from Monetary Policy Department as well. He had the Inflation Analysis and Inflation Expectations Division. He has 10 years experience working at the Central Bank of Uzbekistan. He specializes in the applied aspects of economic modeling, development of forecasting tools, and takes part in the formulation of monetary policy. And our guest from Central Bank of Republic of Azerbaijan, Ismail Ismaili. He's a senior economist at the Monetary and Exchange Division at the Monetary Policy Department. Since joining the Central Bank in 2019, Ismail has been actively involved in key areas such as monetary policy implementation, exchange rate analysis, monetary operations. His contributions include work on overall development of monetary policy framework, which includes liquidity management, calibration of interest rate corridor, and the study of transmission mechanism of Azerbaijan's monetary policy. Ismail has also engaged extensively in international cooperation, working with institutions such as IMF, CComTac, the Swiss National Bank, and the EBRD through various technical assistance, study visits, regional workshops. Okay, this is our guest today, our presenters. Это наши все участники.
These are our presenters. After each speech, you will have a chance to ask questions and discuss the presented information. You can ask questions using microphones. You can see them on the both sides, as you see, or having scanned your QR codes on your badges. You have a special QR code to ask a question. Also, I'd like to invite everyone for active discussion. This is how we are going to get maximum experience and skills of each other. The first one to share the results of the research work on the inflation as phenomena, myth or realities will be presented by the team of the National Bank, and Adam Rusbayev will start to try answering question to understand if monetary inflation is a phenomenon in Kazakhstan. Adam, the floor is yours. Good day, dear colleagues. Thank you, Jandos. So, within our structure of study, we are going to review the references and analytical part, empirical assessments, and to consider the review of references. To start with, I would like to give the floor to my colleague, thank you, dear participants of the conference. We can proceed to the next slide. As you know, our research consists of few parts. According to Adam, here you can see the contents. We can proceed to the relevance of the research. First of all, we should mark that the purpose of this study was to analyze the correlation between inflation and monetary mass in different time horizon and understand the average aggregates and its impact on monetary aggregates and the pricing levels, relevance of the study, necessity to develop effective tools for analysis of the monetary and credit policy measures and policies, which will be expanded to provide the consequences of actions of monetary regulatory policies, understanding of trends and interactions between the key macroeconomic indicators. So we have revised the references and works based on which we conducted the research. I'd like to emphasize that, as you know, there is a statement of introduction of the monetary mass and inflation, and now it is among the economists considered as a topic to be widely discussed. I would like to note the work of some economists. One of the earliest work is the work of David Hume about money, dated back 1972. For the first time, David Hume wrote about increase in the cash mass, causing further increase in the prices. Many economists afterwards noted in this research interaction between the excessive growth of cash mass and inflation. The excessive growth of cash mass happens when the growth of white cash mass is exceeding the growth of the real GDP. In this case, they say that the cash mass is growing faster than the economic potential of the country. As you might know, in 1990s, the monetary field was widely distributed, and many specialists took into account the monetary aggregates compared to the monetary and credit policy. Deutsche Bundesbank could fix the investment trend in the period of the first energy crisis. However, afterwards, we saw kind of decrease in this connection or interaction in the cash mass and inflation correlation. Some economists and scientists related to some specificities and changes in the economics of developed countries in particular, and further on we will discuss it in more details, but we also should know that the recent events have raised the interest to this topic because during the pandemic period, the growth inflation was connected with the increase in the cash mass. After the international calculations, the bank noted in the report that if the factor of increase in the cash mass was taken into account back in 2020, then it would be possible to reduce mistakes in the inflation forecast for 2021-2022. In general, you can see that the idea of monetarism is quite differently considered. I would like to note in the next slide the peculiarities I have mentioned before. First of all, in the countries with higher level of inflation, there is a growth of connection, interrelation between the indicators. And this is connected with the fact that in the low inflation conditions, we know the industry shocks, they have less correlation between each other, and in the long short-term period, we observe that the industrial prices correlate to each other, and the importance of the overall component of inflation is growing. Inflation has close interaction with the level of salaries, wages, and it depends on the volatility of the exchange rate. And also there is close connection between indicators in the long-term period, because the short-term period of inflation in the context of the cash mass changes is more stable, I mean the inflation. At the same time, we should note that the different monetary regimes are affecting or impacting this connection. Also, beneficiaries have noted the deviation of inflation, showing higher rate of interconnection between inflation and cash mass. This explains the fact that the countries with lower inflation have weaker linkage to it because it has less variability of the inflation rates and indicators. In many developed countries, transition from monetary to investment targeted regulations has influenced this connection, because due to this targeting, national banks have anchored the inflation expectations. As a result, the fluctuation, the prices have went down, have gone down. And we should know that different shocks, in particular, the structural shifts, can affect the interaction between the cash market and inflation, like innovations, development of financial markets, institutional changes, among other things. In general, they impact the speed of money circulation, as you know, according to the known formula, and they can influence preferences of the financial assets and structure of economy as a whole. As an example, we can mention the great tolerance period and global modernization, which allows to reduce inflation in different countries.
So the range of these facts have been noted in our research, and Baujan will introduce us to the results of our study. Hello. Nothing can be passed without any trace, as in a famous song. The same with the inflation. And does such violations of the monetary mass lead to this? We have used different approaches. So we start with wavelet analysis, and that is coming from the processing of signals. And the main idea of the method is not just to count the correlation or some other indicators of interaction, but to see on what length of wave. So the length of wave is the period of time, 1 year, 2, 3, 4. How signals, if we look at the time series as signals, how do they match in cycles? We have a basic wavelet. Here we use a very standard economic study. There is a whole zoo of wavelet that we can use. So what we have, we are looking at the cycles of inflations and monetary mass, and we look on how they interact in different periods. Also, we have an opportunity to measure the difference of phases. You can look in the left down corner. There is a hint. There are phases that there are sectors where phases actually match, so they cross-come. There are two indicators, and there's a half of cases when they're out of phase. And we can also measure which indicator is leading in inflation or monetary mass. So these two stages we decided to conduct. And can I hit the next slide? I will introduce you to the results. How can we read the upper graph? We can see the dates, and on the vertical axis, this is a year wave, 2 years and up to 17 years. What does the color mean? If we see enough of hot or warm colors, the warmer are the colors, the more the phases match between two indicators. And with black spheres or contours, these are the regions that 95% of statistic match. We can say that the coherence is very high. So we looked at different indicators, 1, 2, and 3, and we will hit the result. So 3 is the most major result. We can see our favorite periods, 2008, 2010, when we had the targeting, transfer to the targeting in different shocks with oil and currency rate. Also, we can see on N3 instead of N2, when inflation and monetary mass can actually match. What else can we say? if we hit the next stage, we can measure different phases. That is the hint that I said. In the vertical axis, you can see the difference of the phases if it is in the zone of P divided by half, from 0 to P divided by half, because that's the leading monetary mass. And they are matching this. And for M1, M2, these periods, we had 4 periods from 1 year to 4, from 4 to 8 up to 18 years. So we have divided it by the periods of 4 years. In M1 and M2, we don't have enough. So we can see that in M3, that's very vivid and obvious. And then we can say, we can state that M3 in long-term horizons precedes inflation. We can look at the next slide. The next methodology that we used in this study, identification of inflation growth episodes. Here we are looking at 3 stages. We can look at monetization, that is the relationship of money supply, monetary supply to GDP. And if we look at more than 3, then we can count it as a period when we see the load growth of monetary supply. And then we look at the general inflation that was inside the period, for how many quarters there was this growth, this abundant growth or redundant growth of monetary supply. And we can see the period of redundant monetary supply growth. We look at this as a prerequisite for inflation. Let's look at the next result. Previous one? Yes. So we have identified with our parameter 3 episodes. So when in the next 2 years this growth has led to redundant inflation, that's 2006, 2007, 16, 17, and 2021. We can look at the next block of Adam. Thank you. Good morning again. We're looking at the wavelet analysis, and we also identified the redundant episodes, and then we tried to analyze the influence of monetary supplies on the mass. We have used several models. You can see the description in our study that can be seen on the official website of the bank. As per the endogenic indicators, that was the coefficient of industrial activity, coefficient of user and the monetary aggregate M3. And oil price was taken as an exogenic indicator. We're looking at the standard parameter. That was the difference of logarithm multiplied by 100. And in order to overcome the structuring of the model, we used the Pavetsky model. Looking at the particular estimates, the growth or shock by 10% of the major monetary supply leads to the redundant mass inflation by 0.8 percent points. If we look at the quantity results, well, I can bring two examples for the measures taken that also caused the quantity growth of mass that was 0.8% from the monetary supply that led to the storing growth of inflation by 0.7, according to our estimates, of course. And that was 1 trillion by the forecast. And that will lead to the growth of inflation by 0.3% units. Looking at the conclusions of our study, the redundant monetary supply has influence on the inflation rate. Also, we have discovered that it doesn't have the simple interpretation, and on the basis of our conclusion, we can see the long-term relationship between the inflation and redundant monetary supply that causes economic instability in the process of identification of some short-term periods. There were 3 inflation periods from 2000 to 2023, and also we received a qualitative estimate. So in general, in accordance with the estimates that we have, in accordance with the measurements that we have made, that actually confirms that the analysis of inflation should be based on the monetary supply. Thank you, Adam. Separate thanks for the perfect timing, exactly 20 minutes. Thank you for your fruitful presentation, for the effort to confirm or refuse a very famous Friedman hypothesis. And you have doubted the dogma on the monetary nature of inflation with a basis on the Kazakhstani realia. So now, let's continue with the questions. I, as a moderator, will choose the questions. The mics are actually ready for your questions. While everyone is being shy, let me please comment. Can you comment why did you choose Morlet wavelet and not Poland Mexican hat, and how sensitive are the results to the choice of waves? Thank you for the question. Really, as I have noted, Velvet has a very extended library, but why is Morlet wavelet a good one? It's cosinus multiplied by the coefficient, and we can distribute evenly. If we don't have a specific understanding of how the process is generated, we cannot use we can use other velvets, but they are not very even. It is an even one, and it is similar to the even distribution worm. And if we don't have a specific explanation on why the process is acting a certain way, this method is used widely, not only in economy, but it is recommended to use this particular wave. Now let's hit Mr. Tutushkin is asking, based on the general measurement or study, can we say that there is an interconnection in the inflation of 2014-2015. Yes, we can actually look at those episodes of monetary supply growth and inflation. We can see here a correlation that is very vivid. But again, in our methodology, in the probability approach, we used 0.1. And in violet analysis as well, we can play with parameters. If we don't plan the study very well, you can play the parameters that way that everything is pro-inflation. Here, it depends very much on what we would like to identify. And we had quite strict parameters. Maybe that is why through all the methods we had the most vivid episodes that actually appear to be the crisis ones. Thank you. Let's continue the question. The threshold of endogeneity was set manually, and if we come with 0.5 fluctuation, yes, that's a question. We can actually set any threshold, or we can take an average. We met this in the literature. In the next 2 years, it will be just higher than the average in the high monetary. But this is not fair to ask us for such low threshold, because everything will do then. Any episode of monetary supply growth, that we will have too many peaks, and we will just count on too many peaks. We just said that one standard fluctuation is enough. We have 10 minutes to ask the questions. We're a bit limited by time, but you can discuss anything during the coffee break. What is the role of the National Bank in purchase of gold? And I can remind you that in 2023, more than 2 trillion tenge were produced in order to buy the gold. You know, from the current year, we have measures on the mirroring of the gold purchase, and to actually prevent this M3 dynamics, the whole volume of purchase or procurement that we do, the gold procurement, that actually works for the mirroring this volume at the market. And in connection to this, it becomes neutral. The impact becomes neutral on the monetary supply. I can see questions from the audience. Thank you. Valentina Vladimirskaya, Kostak, thank you for the level of theory. You know that the theory is very difficult to be understood by the reader. How much in 2022, a shocking year in Kazakhstan, the monetary supply has grown, and how much it influenced the inflation in 2023? Thank you. Yes, really, we had our monetary supply M3, that is the main aggregator that actually shows the main monetary supply. It's tenge segment and the currency segment. You know that the currency segment can be overestimated due to volatility and the dynamics of the currency rate. In addition to this, there is a range of factors that actually identifies the monetary supply. Out of the tenge monetary supply, that is the growth of credit, the budget fiscal channel, and fiscal operations can also identify it. So this is also the source of monetary supply, that is a credit or a fiscal channel. In general, during the last years, these two channels have been the main one. As per the quantity estimation or measurement, we cannot give you the specific number, but we can do it a bit later. We have all this data, not to speak in vain. So in other words, a monetary supply cannot be named, but did it influence the inflation in 2023, which was the question. We need the specific numbers. There was acceleration of inflation in 2022, and then further with the slowdown in 2023 and 2024, we had a two-digit indicators, about 20% in the end of 2022, in the beginning of 2023. By the end of 2024, there was a major slowdown of inflation processes, and at the present time, the level of inflation is around 10%.
Thank you very much. I would like to note on your remark that there are no simple questions. Please ask your questions. Determination of the correlation and reasons and causes is a complicated exporter quadrate. Inflation in Kazakhstan is at the level of 9-10% with a 16% base rate. Is the current monetary policy effective with the price fixing and reduction, or it is holding the economy without impact of inflation being noted? Thank you very much. I would like to note here that this question is mostly, it covers a bit different topic, but nevertheless, let us try to answer this question. As you know, the whole inflation is at the level as it is. As you know, the inflation is influenced by many factors, including the factors beyond the impact of the national bank in terms of the rate formation and pricing at the market of the lubricants and gasoline. And we have some shocks in the consumer product, food product markets, and this is conditioning the inflation process. And one of the questions is the general level of inflation. At the same time, the national bank is influencing the stable part of inflation with its actions. So the stable part, which is generating the inflation pressure through the inflation expectations, and in particular, it can be determined, among other things, by the growth of cash mass. And in the recent months, by the way, the inflation pressure is quite strong, but according to estimates of the recent months, we see that there is some slowing down of this stable part of inflation process. Thank you very much. Two last questions, please. For Borjan, do you think that underestimation of the exchange rate is the main driver for the inflation episodes and not the cash mass itself? Yes, it's hard to measure what is impacting what. Everything is interconnected in the economy, and if in our study we would measure the impact of the exchange rate growth episodes on the growth of inflation, we would have similar results on this methodology as well. But in this research, we had step-by-step study. We started with the analyzing of the issue. If there is any interrelation and interconnection, make the probability estimation of this, and if there is any interconnection here. And within the framework of the research, we answered some questions and we got some positive results. And of course, the monetary exchange rate is one of the drivers of inflation, but since this all is interconnected, maybe at that stage of study, we have this method would be hardly possible. We are not talking about all factors. Indeed, our approach was used, but at that stage, we were interested in these particular two variables we studied. What is the practical application of this research? Thank you for question. Indeed, in making decision on the base rate, our committee is taking into account not only the mass cash supply, but also other indicators. They pay attention to the real sector, financial sector in particular. To tell you about the applicability in practical terms, we are striving to forecast dynamics of financial market, which would help us in the future in the decision making. And this is one of the steps in this direction. The money supply is very important, but is not the only factor we take into account for adoption of the base rate. Thank you very much for the interesting questions. It's great that all three speakers had a chance to answer these questions. And to continue our conference, we give the floor to Timurbek Baymurzaev, who will speak about the near-term forecast of inflation for Uzbekistan application FAVAR and BVAR models. He will share the experience of development of short-term forecast of inflation. I will repeat the same in English.
He will present his work on application of FAR and BVAR models in short-term inflation forecasting, one of the first such experiences in the region. So, Timurбек, the floor is yours.
Good day, dear colleagues. I'm happy to be here today and present my scientific work. I would like to express my gratitude for invitation to this conference. If you don't mind, I will speak in English.
My talk is related to forecasting models, especially for inflation forecasting. And this research is done with the support of BCC in Switzerland. And I was selected to be as a visiting researcher in Switzerland, in Geneva, and I completed this research. So before going forward, I will present firstly motivation behind why we are expanding our inflation forecasting models, and also then I will present brief information about advantages of BVAR and FAVAR models and data description, and I also show results at the end what we get from our research. Then I will briefly conclude with my final remarks. Next. Why we tried to expand this inflation forecasting, with BVAR and FAVAR. Up to date, in Central Bank of Uzbekistan, we only relied, as for short-term inflation forecast, we only relied ARIMA-based forecast, and we use this forecast as a input data for quarterly projection model. So, but this quarterly projection model is one of the main core models for many central banks, and this model is based on business cycles, so it's gap model, and it does good job in medium-term forecast, but it limits with short-term forecasting. That's why we now considering to expand our satellite models. One of them relates to inflation. Then we have planned to expand with other GDP forecasts, export-import, and remittance forecast. So this research is mainly on expanding the short-term forecast
using BVAR and FAVAR models. And this, I mean, the input which we put is if the forecast is much better, it helps to, I mean, better get medium to forecast, and this helps to better formulate policy decisions to our board. So I briefly introduce BVAR. I mean, compared to other VR models, it has advantage of over-parameterization, because if we expand in VR model, it has disadvantage to produce over-parameterization issues, and it will influence to forecast performance. Considering that, we applied BVAR model, and this BVAR model is done with putting a prior for approach of Minnesota prior. So as usual, models construction, first we determined what's factors of inflation specific to our Uzbek data. Then we applied, as I mentioned, Minnesota prior. Then we use GIP sampling, and at the end we get forecast for inflation. FAVAR model is also has almost the same advantage, but one of the main advantage is with FAVAR model, we can include as much variables as possible in order to capture economic dynamics. So FAVAR, with using principal component analysis, we can extract unobserved economic latent factors that at this time can influence the inflation dynamics. So the structure is also same. We identified first factors that influence the inflation, but the difference is we mostly use a disaggregated of CPI, disaggregated of PPI, and other data in order to get into unobserved economic trends. So approach is we use two-step approach. First, in the first step, we did a principal component analysis, and we extract latent factors. Then we use these factors in VR, and we produce a forecast. So regarding to data description, our variables, we divided our data into two parts. First is the in-sample part, and the second one is out-of-sample part. First part is starts from 2024 Q1 until 2023 Q3. So the rest 4 quarters, we use it as auto-sample forecast. So we checked our forecast performance based on from 1 to 4 legs, and this applied for BVAR and for all 3 models. In BVAR, we divided, we construct 3 models based on importance to inflation. So here you can see our data sample divided into 4 sectors. It's price sector and economic activity sector, and monetary indicators and foreign indicators. And in this part, as you can see, we have 3 BVAR structured models. First 5, BVAR 5 is the main models we choose, and we want to see whether this forecast performance is doing better or not. Then we included credit stock, because last 3-4 years, credit growth is high in our country, and it's also one of the main drivers of inflation from demand side. And also we added to this producer price index. This is also because last time, we need to consider, because last years we have tariff for households and for business entities as well, and it's also causing to formulate domestic prices. Then in BVAR 10 we have our external factors. This includes remittance. It's also one of the main driver of income in our country, and the rest one is energy price index, is external energy and non-energy price index. As for FAVAR model, the same. We also applied 4 sectors, but we mostly desegregate. We use data from the segregated data set. So this includes prices, economic activity, and monetary indicators, and also foreign variables. Here in foreign variables, we added also FAO index, desegregate one, and world commodity index. So based on our results, first we select optimal legs. How we select it, we run, I run with 4 legs, and I choose which the entire forecast error is the least one. So one of thing I need to mention that in order to compare our forecast performance, I also constructed benchmark model. This benchmark model is based on Bayesian ER that I use only inflation, and with Bayesian method I did forecast, and the result shows that with leg 1 it has better performance compared to other legs. And for BVAR 5 we have better forecast performance for leg 4, and for BVAR 7 leg 2, and BVAR 10 leg 1. So using this optimal legs, I compared with benchmark model, and this also for FAVAR model. When I did for FAVAR, leg 1 has better forecast performance for entire forecast period. So when I compared our BVAR and the FAVAR models to benchmark model, for entire forecast horizon, FAVAR has a lowest forecast error, and but in this case I need to mention, when comparing each horizon and individual models, benchmark model has a better performance in 2023 Q3 and 2024 Q2. So period 1 and 4, benchmark model has a better forecast performance. But in period 2 and 3, which is 2023 Q4 and 2024 Q1, BVAR 7 and BVAR 10 has a better performance. And also I did with, combination method, so I just averaged forecast errors and compared, but averaging is not performing well compared individual forecast performance. So in conclusion, I would say that FAVAR model, if we take whole forecast horizon period, this performs well, but if we see individual forecast performance and in each forecast horizon, individual BVAR models has better forecasting performance. So this research paper concludes that when we construct our short-term forecast, we just not rely on overall forecast performance, but we take individual forecast performance which has better forecast in each horizon. So we use as much as all models which has lower forecast errors, and we construct it. So this data will be also in the next our research will be compared with forecast performance from quarterly projection model for 4 quarters. If our currently forecasting results outperforms our QPM model, so we can use this as a satellite model, and we can use this as a input data for our QPM, and in the next step we also have planned to expand these FAVAR and BVAR models not only for inflation but its components, and also for GDP, export, import, and also remittances, because we also use this data for quarterly projection, and this helps to kind of minimize error in our forecasts. Thank you very much. If you have questions, I would like to answer.
Thank you so much, Timurbek. Great presentation. Today you presented a study dedicated to comparative assessment of 2 approaches to short-term inflation forecasting to Uzbekistan. I think it will be super useful for us, for all the expert community here. And I have questions, but I would like to ask first, give the floor from the audience. We have a lot of questions to you, and you left us 5 more minutes for Q&A. So we'll start. First, Juanos Timirgaliyev is asking, have you considered including indicators related to Kazakhstan's or Russia's economy into foreign variables? For example, trade. Do you think selected parameters are sufficient? Thank you.
For initial this research, I only use, as I mentioned, energy price index and non-energy price index from World Commodity Index, and also FAO index for FAVAR. But yeah, this is on stage of development. This modeling. So we can also consider and add trade volume. Also, we can also add prices because our inflation dynamics is more sensitive to partner countries' inflation from supply side, especially from food products. So we can also consider, price dynamics of Kazakhstan and also import dynamics from Kazakhstan. So we need to, assess whether it significantly affects to our inflation dynamics. Then we can also add, we will think about,
Thank you. The next question is from the audience. Of inflation from third quarter of 2023 to second quarter of 2024. Are your forecasts comparable with actual data?
Yes. This is forecast. From 23 Q2 up to 24 Q2 is actual data. So we compare it with actual data.
Good. Next question is from Nordaulet. How many factors have you extracted from PSEA, and could you approximately identify them? For instance, global factors, real factors, nominal factors. How much variability in inflation do these factors explain in PCA? Thank you.
So in FAVAR model, I extracted 6 factors, and I also see, contribution of these factors. But I didn't do its composition, decomposition of these factors. So for this research, I just showed, the extraction of 6 factors in my paper, but I didn't decompose it based on foreign, based on domestic. But I can add it because I didn't do this. My main focus was about forecast performance. So it's not about, in the next stage, in order to briefly explain to audience why is the forecast maybe deviating, or why is the forecast is going. We can, decompose these factors, but for this research, the main focus was about analyzing forecast performance.
Great. I just want to mention, you can ask in any language, we will translate them. Не стесняйтесь писать на русском тоже, мы переведем их.
Don't be shy to write in Russian. We will translate it. Don't forget about the mics.
How well do FAVAR and BIVAR models capture structural characteristics of the Uzbek economy, such as price regulation, monetary transmission lags, or supply-side constraints?
So this can be only done with calibration, I guess. Last year, this year, and last year we have tariff regulation. So we still don't. We expected in previous year. We expected tariff liberalization will be significantly affect to inflation, but we saw that it's affected, but not as much high as we expected, because previous year we expected there was huge price increase in energy and in electricity and gas, but within the year we see it has much lower effect because of the maybe consumer behavior also changed because of they have high expenditure on tariff side, so they not expanding much on their consumption. So there's a might change behavior. That's why it should be, my answer is it should be analyzed. So now from May, from tomorrow, we have a second stage of energy tariff reforms. So we still, this second effect, we also have, I mean, we have some expectations that secondary effects will come to inflation, but still not clear how much will come. So it takes some time to analyze, and we need always to calibrate. So with variables, with maybe we need to calibrate always. I mean, it takes some time to get clear, I mean, vision about how tariffs and how structural change will influence too, because there are a lot of factors from consumer behavior, from supply and demand. Yeah.
Okay, and one question from me, just a very relevant question. What latent factors does the FAVAR model incorporate when you analyze inflation dynamics? Unobservable factors.
So could you clarify this?
Some factors that you can't observe, how, what they might be, what you are meeting in your research.
So, as for my understanding, factors mostly I mean, unobserved factors, I think, coming from credit side and from, I mean, demand. I mean, currently it's a kind of mixed. I mean, factors mixed, because we are observing now both supply side pressure to inflation because of and also in previous time we also had in 2019 we also had supply side factors. I mean, we have also tariff increase every year. We had a tariff increase, so it's kind of mixed. But from demand side, as our data captures as well from 2020, so 22, so this period also huge boom from credit side and also remittance. So this, what I can say is this, it's kind of mixed from supply effects also, and from credit cycle and from remittance side as well. So it's much difficult to determine which has a higher pressure, but both sides has playing kind of interconnected roles.
Thank you. One of the popular questions, I believe, is how do you communicate your results, research results in Central Bank of Uzbekistan?
So how we do, we publish monetary policy reports every 4 quarters, and we provide our forecast in this report. And we also, besides providing forecast, we also provide the difference between previous forecasts. I mean, for example, this period we provide our forecast and how it changed compared to previous our monetary policy report. So we, with the help of this, I mean, quarterly projection model, we decompose factors and we explain based on what factors we have deviation from our previous forecast. It's our communication method. Besides that, we also have press conference during after policy meeting. So our chairman and deputy chairman also explains if there's a questions from the audience. They explain that, I mean, deviation, what factors played higher role. Yeah.
Thank you. Just a quick reminder, we have 5 minutes left, and we have a nice interaction. Another speaker from the panel wants to ask you a question.
Спасибо. Тимирбек, я вот хотел...
Timirbek, I wanted to clarify those methods, sorry that in Russian, those methods that you have identified, that you have stated, and they are used in official and continuous process of decision making in the tariffs, or And that is an ad hoc approach, and this is due to your research method. And if so, if that is used in official manner, can you make an example? How do you forecast those factors in Favar model or maybe in other models? How do you forecast other indicators in order to receive this?
Previously, the main objective of expanding this forecasting model is to use as input file for QPM, quarterly projection model. Up to date, this modeling is on stage of development. Up to now, as I've mentioned previously, we use it ARIMA modeling. So using this ARIMA model, we forecasted core inflation. So we used 1 period ahead core inflation data. And so our QPM has an inflation part divided into core inflation, fruit and vegetables, and regulated prices. So in part of core inflation, ARIMA results of forecast from ARIMA, we use as a NTF, and we put for this QPM model. For fruit and vegetables, we also have our forecasting model. It's also ER model, so we also use this for NTF. We put from fruit and vegetables. And for regulated, we have information from government. We have good communication with government, so they tell us beforehand what kind of regulated price is expected to increase. So we also have a forecast for regulated price, but it's most of regulated price we have data, so we expect. So we put this information to our QPM as well. So using this data, so it helps for QPM model. It helps to know where the inflation will be in next quarter. But this, but we want this NTF for longer period, not for 1 quarter, but quarter 2, quarter 3, based on forecast performance. So this FAVAR and BIVAR, it's, as I said, it's on stage of development. After completing this, we use this for Q2 and Q3 up to how well it's performing. So for QPM model, it helps to sense where inflation will be for short-term period. Yeah, it's the main objective to expanding. It's a kind of satellite model for our QPM model. Yeah.
Good, great, thank you. The last 2 questions. I believe if you still have some burning questions, you can talk later, right? I believe it will be great. So one of them from Nursulan Nursiid. I think the most interesting one is, what are the main limitations of your method?
Limitations?
Limitations you perceive as limitation.
So limitations, maybe I think I need to collaborate more, because based on BIVAR we have parameter sum. So I use standard parameters. So maybe I need to check for other parameters. So I need to collaborate, for example, lambda 1, lambda 2, lambda 3. And for maybe FAVAR, I use only 6 factors extracted. Maybe I need to see how well it performs when I decrease. So limitation, maybe I need to spend more on calibration. And also limitation, maybe, as we told, now currently we have tariff reforms, so we have the next stage tomorrow. So we still don't know how this affects to inflation, but we have that it has secondary effects. But in order to see how well this structural change in prices affects, we need some time to analyze, and after that we can recalibrate again. Yeah.
Okay, great. And the last question, one of the provocative questions, I believe, is given the recent US policy in stabilizing trade balance and expected weakening of US dollar, so increasing, strengthening of your domestic currency, will central bank consider reducing the rate accordingly?
The rate, policy rate, you mean?
The rate.
So, tell the truth, we are not seeing to, I mean, we also deliver this information in our press release. We are not seeing to, I mean, to soften our policy rate, because we see now during 3 months inflation accelerated, both headline inflation from 9.8 to 10.3 currently we have. So our core inflation also accelerated much higher compared to headline. So we have seen the supply shocks coming, and at the time we have seen high remittance coming, credit boom. So from demand side and from supply side, so these both factors signaling us not to I mean decrease our policy rate, but next stage we see after May if the the effect is higher, if it's affecting to expectations of our household and business entities. So there's also high possibility to to even increase our policy rate, because there's a really pressure to inflation. That's why we're not seeing. But even this U.S. and U.S. tariff policy, we see this as much inflationary because of higher global inflation. So it's also from not only inside we have pressure, but also from foreign inflation pressure. So we currently don't see such options. Yeah.
Thank you so much. Thank you for your insights. Great work. Мы движемся в хорошем темпе.
We do have a nice pace. No one is falling asleep. And now there will be a short seismic exercise. If we won't hear it, we will ignore it, and we will stay in the hall. It should be at 11, but if we don't have it, we will continue. Now, our next speaker, Ismail Ismaili from the Central Bank of Azerbaijan. He will present his work on implications of diverging monetary policies on exchange rates and capital flows with the perspective of Caucasus and Central Asian countries. He will present in English, but if you have questions in Russian or Kazakh, please ask them. There were very interesting questions for the previous speaker. I think that was very interesting to listen to the
Ismaili from the Central Bank of Azerbaijan. In his work, Policies on Exchange Rates and Capital Flows, a Policy Perspectives from Caucasus and Central Asian Region, he will explore the effects of diverging global monetary policy cycles and exchange rates and capital flows in emerging markets. So I now give the floor to Ismail, please.
So, yes, it's for. So thank you for the introduction. Good morning, everyone. First of all, I want to thank National Bank of Kazakhstan for organizing such great events and gathering all of us to share our opinions and views on these emerging issues, important issues for all of us and for our region. So today I want to give brief information about my policy paper. At the beginning, I want to mention that it is, rather than it is empirical research, it is a policy analysis and perspectives for the emerging markets, and special focus on the Caucasus and Central Asia. So I also want to mention that the opinions and views are on my own, and it doesn't reflect the official stance of Central Bank of Azerbaijan and its management. In this paper, I want explore the impact of diverging monetary policies on exchange rates, capital flows, and financial stability. As I mentioned, the emphasis will be on emerging markets and CCA region, and the aim is to deliver actionable policy recommendations regarding these recent issues. I want to talk about the global
Давайте пока прервемся. Я имею в виду, останемся на...
Let's stop, but let's stop the presentation for a moment. Yeah, that's all.
I want to give a bit information about global overview now. Recently we witnessed that Fed keep its interest rates a bit high, and ECB did some rate cuts due to its economical concerns. So the spread between these two major central banks just divided, and it strengthens the dollar, US dollar and dollar index, and make the other currencies depreciate. And it also affects the emerging markets. It forces the capital flows from emerging markets, because when dollars is getting strong, it definitely affects the currencies of emerging markets and put some pressure on their currencies. If we look at the policy rates from 2020 to 2024, we see some synchronization. We see that against the global inflation just went up globally, and central banks started to increase its interest rates to fight against it. There is some synchronizations, but at the same time, while the major economies increase their interest rates, emerging economies somehow forced to increase their interest rates in order to keep that interest rate spread. So if we look at the interest rate, Fed interest rate hikes, and the exchange rate of our currency of our regions, we see that there is some correlation between Fed interest rate hikes and depreciation of those currencies. And this, of course, there are some other factors behind this correlation, but federal rate hikes is one of those factors to put pressure the currents of the or regional economies, and it make higher cost of foreign-dominated debt, and of course it creates some inflationary pressures. So in my paper, I look at some theoretical frameworks. It is a Mundell-Fleming model, is LM curve. It explains that in a small open economies with a floating exchange regime, when interest rates is decreasing, it depreciates the currency. It makes the inflation capital outflows and increasing net exports. And when the interest rates increasing, it affects the appreciation of the currency, and it increases the capital inflows and decrease the net exports. And interest rate parity, the small economies generally coordinate their interest rates based on the movements on the major economies. For example, when there are interest rate hikes on major economies, for example, Fed, ECB, they also increase the interest rates, and vice versa, again to keep that interest rate spread and to defend their exchange rate. And there is a race dilemma in 2016. In its research, Ray just mentioned some interesting topic. It mentioned that rather than trilemma on monetary policy, right now there is some dilemma because even if the countries with capital mobility and floating exchange rate, they are not that much independence on their monetary policy because of dominance of global financial globalizations. It put some pressure on small open economies to adjust their interest rates to defend their currency. I also explore some past experiences. For example, in 2013, there was a taper tantrum when Fed announced that taper tantrum, the capital flows, it affects some emerging economies more. For example, India, Brazil, Indonesia, Turkey, and South Africa observed a huge capital outflows, and their currency depreciated after that announcement. And of course, also 2022 and 2023 Fed hike cycle. It also put some pressure on the currency of emerging markets. For example, again, the currency of Turkey and currency of Argentina depreciate a lot. And it also shows the effect of federal Fed decisions on the economy of emerging markets, especially the capital flows there and their currency. Here I want to mention the global liquidity and dollar's role. So dollar as a global reserve currency, and also if we considering that more than half of the global transactions is based on the US dollar, so when US dollar gets strong, it definitely impacts on the currency of the small economies, especially the emerging market economies. And here also we can see some correlation. For example, if you look at the Fed rate hikes from 2022 to 2024, we see that global debt based on the percent of GDP weighted average decreased because of the liquidity factors and constraint of the liquidity because of the strong dollar. And also if we look at the price index in our region, we see that in those years the prices went up. Of course, it was the global factor. The interest rates globally increased, not just in our region, but globally. But also the strong dollar and appreciation of the currencies in our region put another pressure on inflation, and it also contribute to inflation to go up. So in research 2024, NBIS just come to conclusion that when dollars depreciated, in emerging markets economies, the local currency bonds increase, and when the volatility index increase, it affects the equities of the emerging markets. And when the change in policy rate differentials, for example, when there is a huge spread, the spread is increasing between emerging markets and the Fed rate, it affects the FX loans, and FX loans is increasing in emerging markets. So here I want to draw attention to capital flows in our region and financial stability. We see that between 2020 to 2024, there is huge volatility in capital flows in the same region. And key drivers here is political events, commodity prices, and Fed policy rate. Here I want to draw attention to again geopolitical factors. Because of our region's close tie to the Russia economically, what the some shocks to Russia spill over to our region. For example, after the Russian-Ukraine war and the sanction by West to Russia, remittances in our region just surged, and this brought some advantage and disadvantage. Our region just attracts some capital and their currency appreciated, but at the same time it led to some inflationary pressures, mainly in the sector of real estate. So here, as a policy recommendations, what the countries in the region can do in order to diminish those effects of those shocks. And first of all, I want to mention the strengthening international monetary corporations. The first one, I think that we can create a task force to monitor and respond to the policy spillovers in the CA region. What I mean by this, for example, last year I was participating in a workshop in Almaty, Skamtak, and focus is the key issues in the monetary policy communications, and all the participants from the central banks, they shared their experience, and it was so useful. They shared what they did as a communication, as a positive experience, and I think that we can collaborate on monetary policy framework, monetary policy communication, monetary policy tools, and what we implement and get a positive results, and we can share these among us, and also the negative ones also. For example, what we did, for example, we did this and we get the negative results. So if you also if you also want to take this action, just consider these negative sides also. And second mechanism is the expand, for example, IMF precautionary facilities and regional safety nets via institutions like Asian Development Bank, Eurasia Development Bank, and it is, I think that it is essential to answer the shocks in the emergency issues. And the second recommendation is enhancing exchange rate flexibility and macroprudential framework to reduce exposure to the external shocks. I think that floating exchange regime, in some cases, managed floating exchange regime is essential to absorb the shocks, and we, in this case, we should have FX reserves to make our current exchange rate smooth. And also developing local currency bond market is essential because if we have a lot of lending from external currencies, when there's a shocks, we can face with the debt burden. And also diversifying reserve portfolios and applying targeted capital flows is essential. And last, strengthen fiscal and structural policy to mitigate external monetary spillovers and enhance economic policy is also essential. Here I want to mention adopting counter-cyclical fiscal measures, diversifying trade and investment partnership, and advancing structural reforms in governance and financial systems. And also the coordination between monetary policy and fiscal policy is important, because if they contradict, neither monetary policy nor fiscal policy will be effective. That's why I think that as a central banks, it is essential to engage with the financial ministries and coordinate our policies. Thanks for the for your attention, and I want also to learn your, to know your perspectives on these issues. So what we as a central banks can do to diminish those external shocks, and to learn your views on this topic is also interesting for me. Thank you.
Thank you so much, Ismail. You changed the perspective. Thank you very much for the presentation to the global dollar cycle and how small countries are not immune of them. I think this changes of perspective is useful for us, for all of us, for researchers, for policymakers, and moving from small open economy perspective, which I guess is outdated nowadays, and all of us are not immune to global dollar cycle. And thank you for bringing up this perspective to today's discussion, and even the siren didn't disturb you. Сейчас мы переходим к сессии вопросов-ответов.
Now we proceed to the session of Q&A. Please feel free to ask your questions. Again, use your QR code. I think that it was very illustrative that during the siren training, all participants stayed in the hall. It confirms that the topics are very interesting.
Let me start the first one. So you showed us that monetary policy autonomy is compromised in a global financial cycle scenario. If floating exchange rate regime doesn't ensure independence, given your perspective, given under suggested dilemma, not trilemma thesis, which tools do you think can prove effective for our countries in the region in mitigating external shocks? Thank you.
Thank you for the question. As I mentioned in my recommendation, I also think that floating exchange regimes is the best option for the general for our region. But we also consider that even we have floating exchange regimes and full capital mobility, we have small room, not small room, or room for the independent monetary policy just getting smaller. It is so we also I think that we also consider this factor also. So we just implement a full independent policy, even if we have floating exchange regime. I want to mention this. And yeah, the best option is floating exchange regime, but sometimes we can, of course, from the perspective of IMF, it is not accepted positively, but I think that in the situation of huge shocks, we can intervene or exchange regime in order to smooth it rather than to fix it.
Thank you so much. Now we open the floor to audience questions. The first one from Alex. You advocate for regional safety nets, financial safety nets. Which steps do you think most realistic for our region? A joint reserve fund, expansion of EDB mechanisms, or bilateral swap agreements?
Thank you for the question. So I think that it requires the deep analysis which options from this is the best. Depending on the situation, depending on the country's conditions, the country may prefer one of these, but right now I can't say that which one is the best options. I would say it requires some deep analysis.
Thank you. Great. Another question from the audience is that you mentioned the divergence between the Fed and the other central banks' monetary policy. How relevant do you think is carry trade risks for the region, especially considering the growing role of short-term yield-seeking investors? Thank you.
Can you repeat the question?
So the question is, what do you think, how do you think is relevant the carry trade risks in the region, considering the growing role of short-term investors? That's a question.
So it is interesting point. I think that nowadays central banks hold their positions as a waiting what's going on the global economy, because there are a lot of uncertainty in the global market. So central bank prefer being in a position of waiting rather than doing some actions. But in this case, I think that monetary policy communication, transparent communication will make the investors expectations, I think that central banks should increase their communications to in order to diminish investors' unexpectancy, and also anchoring their views, also anchoring inflation, their inflation expectations. And right now, I think that the main focus should be on communication rather than doing some abrupt actions.
Good. And something to think about later as well, right?
Yes.
Yeah. And I believe the last question for today, for this seminar, if some people don't want to ask. Sure.
Ismail, at the end of your recommendation lists, you mentioned that the monetary and fiscal policy should coordinate. I have a question. In which areas you see right now in our region the potential for such coordination? And if monetary and fiscal play as a team, who's the main player?
Thank you for the question. As I mentioned before, there should be coordination between fiscal and monetary policy, because otherwise none of them will be effective. As a central bank perspective, our main issue is price stability, inflation, and macroeconomic stability. And from the perspective of fiscal policy, they mainly focus on growth and welfare. So in this case, I think that, for example, if we implement a tight monetary policy, fiscal policy also should do targeted spendings in order to not dampen the effective of monetary policy. It was enough. I don't know if you get what.
Okay, thank you. Thank you for your answer.
All right. Thank you very much, Ismail, for your presentation. Unfortunately, we still have questions, but unfortunately, we have no time. And I thank all the presenters today of this panel. I think it was very productive. And we will continue thinking about the issues you raised today afterwards as well. So let's stay in touch afterwards. And спасибо всем.
Thank you, everyone, for your attention. Thanks to participants of today's first panel. It was very productive. Good luck in your further research and publications. Now I give the floor. Give the floor to the next session. Thank speakers. And I want to say that we have to note that our bank, National Bank, cooperates with analytical centers and scientific research centers, and we made an award for the macroeconomic analysis. And I would like to ask the Deputy Chairperson, Mr. Tutushkin, so that he names the first awardee of this, the first nominee of this award. Thank you very much. As you said, we decided to award the best forecaster, and this is first of all allows us to recognize the high level of professionalism of experts involved in forecasting macroeconomic indicators of Kazakhstan, and allows us to confirm upon what we're thinking. Our cooperation is an important part of communication and the implementation of monetary policy. We had two main criteria to choose the winner. First, it was the quantity criteria by assessing the smallest predictive error, and also we took into account the involvement of and regularity of respondents in the survey. The first winner is Halyk Finance. I would like to invite the representative, Mr. Murat Temirkanov. Congratulations on your well-deserved award. We hope that this tradition will become an important part of our professional culture. Thank you very much for the work that you are doing. We're happy for you. Let's continue. Honestly speaking, that's quite unexpected. We update our forecasts quarterly. We received new forecasts. We are not used to looking back, and honestly speaking, forecasting macroeconomic indicators, that's very ungrateful labor. But now we are the best on inflation. That's a bit strange, but taking this opportunity, I would like to thank the National Bank. That is my personal opinion, and I think that everyone, that among the state agencies, that's the biggest analytical center, that's 100%. And today's meeting and conference, those who participate on the basic rates, and there are such hot discussions. These are open discussions, and it's done really well. And if the government does their research and we would openly discuss that, we would live in a different Kazakhstan. I would like to thank National Bank for their work, and I'm very glad that you do it on a high scientific level. Dear colleagues, we have a coffee break now. A bit late we were, and at 12 we finish coffee break and meet here. We continue our conference.
Уважаемые участники, мы предлагаем...
So, dear participants, let's start our second session. It is called Consumer Patterns and Financial Stability. Sabit Timirkhanovich Kakimzhanov will be the moderator. PhD in economics, who worked in National Bank from 2015. He was head of the Department of Finance. Now is a deputy. Sabit Mirkhanov, please, you can start. Dear colleagues, hello. We have a second session on the consumer behavior. So consumers are the center of all what we study, the macroeconomics. This is the behavior of consumer that sets actually the behavior of the economy. The consumer saves, the consumer spends or invests. Sometimes the behavior changes, and then of course we measure our policy. Everything that we're doing is measured on how the consumer estimates us. On the financial stability, not always the consumer can do what we want them to do, but sometimes the consumer is in the situation when he or she has to act linearly and not somehow else. So we have two main topics. That is from Alisher Aldashev and Birjan Batkev. Alisher is the economy professor in the International Economic Schools in KBTU. He has a PhD in economics from Regensburg University. He worked in ZU, Mannheim, and also participated in study projects, research projects for the Ministry of Labor of Germany, Volkswagen Foundation, and National Bank of Kazakhstan. Main research interest, development economy, labor economy, economy of language, and non-formal institutes. Birjan Batkev is co-author. And the second one is, let's give the floor to Alisher. The floor is yours. Thank you for presentation. Today's presentation is aimed at the work that we did for the National Bank. It is based on some microeconomic shocks that influence consumption. I made the presentation in English because we have too many terms in English and it's difficult to translate them into Russian.
Specific section of the project, and it is based on the effect of COVID lockdown on basically the firm activity in Kazakhstan using this spatial data. So the structure is as follows. There is the introduction with some overview of the literature, then description of the data we used, then a bit of the short description of the context of the lockdowns, and then we summarize the estimation model, the effects, and we conclude. So it's going to be a relatively short presentation, I think. So there isn't really much to describe about COVID. Everyone experienced it, and we know what kind of major disruptions it had on the economic activity. So disruption of supply chains, which led to shortages of supplies. There were the employment effects pretty much across the globe, firm closure, both temporary closure of firms and also permanent closure as well. And the revenues of firms declined because also, given the mobility restrictions, the movements to shops slow down and people spend less, which resulted in decline of revenues of the firms. In terms of the literature on the effects of COVID, it's quite abundant. And what is interesting, quite a few papers, given that this is a recent phenomenon and more detailed and high-frequency transactional data becoming available, quite a few papers were using this highly disaggregated high-frequency data to assess the effects of COVID. So papers like Chronopoulos and others use high-frequency data in the United Kingdom on purchases, and they found also decrease in discretionary spending. The interesting paper by Chen and others, they used the Union Pay and also QR payments data, which is really on a highly disaggregated level and with very high frequency. And they show that the decline in consumer spending was basically a whopping 32% in China. Similar effect was found for the United States. And another interesting paper by Harrell for Israel was interesting in a way that he showed heterogeneous effects in the sense that the lockdown did affect the large firms. However, the small businesses were largely unaffected by the lockdown. So what we were interested in is to assess the effect of the COVID lockdown on the economy of Kazakhstan and especially on the transactions and firm activity, although in this paper we mostly talk about the firm activity. And we also distinguish between the city, because this is based on the transactional data of Almaty, but also including the surroundings, the suburbs, so it's also excuse me, separating the effects for the city versus the rural areas surrounding the city. The data set is quite interesting. This is the very high frequency data, so it has the daily data on transactions coming from individual cash registers of firms. They are collected, I think this was the project of the city authorities, so the data from every cash register is collected, and the data is available on a very highly spatially disaggregated level. So we basically have polygons or city blocks of 500 by 500 meters. So it's a very almost pixel level data, and you have several firms within a sector, and it's also daily, so we have the volume of transactions, and we also have the number of active firms on the spatial level and on the time dimension. In terms of the content, so basically there were two lockdowns which were kind of major in a way. There was the first wave from March 16th to May 11th. It was quite severe in the sense that there was the restriction of movement, there were the roadblocks to enter the city. So basically, in a way, the mobility between the suburbs and the city was interrupted. And on April 28th, there was a gradual loosening of restrictions. And by May 11th, they were completely lifted. And then the second lockdown began on July 5th, and there was a time where there were the worsening of epidemiological situation, so there was the high incidence of COVID cases. So unlike the first wave, when basically no one heard of COVID, the second lockdown was quite severe. The incidence rate was high, the excess mortality showed up. And so it lasted about a month, so from July 5th to August 5th. Although, what needs to be said, the authorities were more prepared for the second lockdown because it was not the total lockdown like the first one. There were certain restrictions, but the firms were allowed to operate under certain conditions. So here on this graph, you see the aggregate daily data on transactions. And here, in this work, we concentrate only on retail. So we have the food retail versus non-food retail for comparison. And we have city versus the rural areas. And if you look the vertical dash bars, so the first two is separate the first lockdown, and the third and the fourth vertical bar give you the second lockdown. And as you can see, it's really apparent. The effect was quite severe. There was a huge drop of transactions, and especially in the city. So in the city, the decline was huge. In the rural area, it was quite significant, but somewhat less than in the city. And also, the transactions of non-food, what is interesting in the city, returned almost to the pre-lockdown levels. However, the food transactions remained relatively low even after the restrictions were lifted. And during the second lockdown, the decline was much smaller than during the first lockdown, although if you see the red lines show the incidence of COVID cases, although we don't have the incidence separately for Almaty. This is the aggregate for Kazakhstan. So as you can see, with the big increase in the incidence, the decline in transactions during the second lockdown was much smaller compared to the first lockdown. And this is basically showing the same graphs, but now for firm activity. So this is the number of active firms. So in terms of the active firms, the situation is somewhat qualitatively similar to the previous graph. There was the huge decline during the first lockdown, and the situation gradually recovered after the restrictions were lifted. And during the second lockdown, the decline was much smaller than during the first lockdown. So we were interested in assessing the effects, although quantitatively it is somewhat difficult in the sense that the COVID affected basically every industry, and so it's relatively complicated to find a relevant control group because basically there was no industry which was completely unaffected. So the basic model is the difference in difference, and the way we did it, we basically consider the food retail as the control group, although this is a somewhat tricky part, but the idea is that the food retail was, the effect on it should be much smaller because the food industry was less restricted and was more allowed to operate relative to the non-food industry. The non-food industry faced more restrictions compared to the food retail. The outcome variable is the number of active firms in logarithmic in logarithm, and we also did treat separately the small shops versus large shops. So the idea was that not only did we have the number of active firms in the data, there was also the number of cash desks available per day and each specific spatial unit. And so the idea is, if the number of firms and the number of cash desks was the same, that means you have one cash register per firm, which corresponds to small shops. If you have more cash desks, that means you have at least one bigger supermarket which had several cash registers. And the idea was, of course, that the effect should be bigger for bigger shops because there were more restrictions applied to bigger places because the number of the distance between the consumers were imposed and so on. So here you see the summary of the average treatment effects on the treated. So basically the effect of COVID, and this is the first lockdown, on the number of active firms. The F-stat basically shows that we do have more or less the parallel trends, so we can compare the control and the treated group. And although for the rural areas we don't really see much of a significant effect, although in magnitude there is still a decline in firm activity, we do see strong effects for the city. And as we expected, the effect on small shops was much smaller. So this is roughly 7% decline in the number of active firms. But for the bigger supermarkets, so that let's say the areas where you have at least one supermarket, the effect is roughly 20% decline in the firm activity. So we can see that the first lockdown brought substantial decline in the firm activity. Now, we repeated the exercise for the second lockdown, and of course the raw data also showed that during the second lockdown the effect must be somewhat smaller, and there were several reasons to that. It looks like both firms and the authorities adapted in a way, and so the imposed restrictions were milder, and under certain circumstances the firms were allowed to continue operation. So this is the second lockdown. Qualitatively, this is more or less the same what you saw on the previous table, although in magnitude it is smaller. So although for the small shops in the city there is still significant effect, but in magnitude it's really close to zero, suggesting that the second lockdown was relatively minor relative to the first one. And if you look at the effect on large shops, so there was roughly 20% decline during the first lockdown, and during the second the effect is around 8%. So definitely we see the adaptation, although we cannot separate what was the effect of adaptation on the firm side, what is the effect of the adaptation on the administrative side of the city, but at least we see that the effect is much smaller during the second lockdown because of adaptation. So we do see that there are really heterogeneous effects depending on the retail size and firm location. Different effects in the city relative to the rural areas, and also the difference depending on the size of the shops. So much smaller effect on smaller shops and much bigger effect on the bigger shops. So you see that during the first lockdown, the larger shops were hit substantially, which resulted in about 20% lower firm activity. And in cities, the effect is about 7% for the smaller shops. And in rural areas, although no significant effects were found, in magnitude, it's still negative. I think it was about 10% decline for the larger shops, although it looks like the data for the rural areas is much noisier. And for the second lockdown, we see that the effect is much milder, about 8% decline for the larger shops and 2% decline for the smaller shops in the cities, which probably suggested some adaptation on the side of both firms and the city authorities. So this is the basic summary of our results in this particular section. So thank you, and we can move to the Q&A session.
Thank you. Do we have questions from the audience? They should have been submitted by now. Can we have them on the screen? All right, Alisher.
Размеры выборок действительно.
The sizes of samplings were different, but it is connected with the fact that, in fact, we have more geographic units inside of the city compared to the suburbs and rural areas, at least according to the data we have. Because not the whole Almaty region was covered. I cannot tell you how many kilometers was the interval for review, first of all. And secondly, there is a huge difference between the geographic units where we have smaller stores and bigger supermarkets. In the large supermarkets where we have the number of cash registers exceeds the number of firms, there are not so many of them. There is big difference because of that. On the same question, I would like to ask, what is the unit for observation where N is 60,000? The number of firms, it was stated somewhere, or number of transactions, or number of firms multiplied by the number of periods. N, to understand the size, the scope, N is the number of geographic blocks or units, 500 by 500, multiplied by the number of days of sampling, region days.
Instead of the number of cash registers. No, and for the simple reason, we didn't have any information on the number of people working. So obviously, the ideal scenario which we would like to have in the data is also to have not only the number of employees in each geographic unit, but also ideally, we would want to have the number of people in each geographic unit, because this is, especially given the restriction on mobility, this would determine how many people would really purchase in this area. And unfortunately, we didn't have it. Исходя из ваших исследований, насколько
the actions of the National Bank, were they correct during the COVID restrictions based on your research? In our research, we did not separate actions of the National Bank from the actions of the state as a whole. The main things we can see, like during the second lockdown, indeed, notwithstanding the lockdown, the decline was less than in the first lockdown, which was connected with the measures taken. I even don't remember if there was a shake by that time or not, but there were some algorithms for some categories of businesses. Different rules were established, and compared to the first lockdown, there was no complete restriction for movement. Also, it was allowed to move between the city and rural areas compared to the first lockdown. So here we can see that only some actions taken have helped to mitigate that shock, but we did not separate actions of the National Bank from the state as a whole. Neither we did for the data on actions taken by the companies themselves, starting from the frames with the sanitation facilities. We cannot separate this data. Thank you. Can we go back to the graphs on page 8 and 9? Could you please explain once again what is happening here? Is it the number of transactions? Yes, please show us the graph on the screen. Left top, for example. This is the volume of transactions in tenge. And red is for the number of COVID cases. The vertical graph on the right is the number of cases of COVID per million, and on the left-hand side, this is the volume in tenge. This is aggregated data for city and for rural areas near the city, for the suburbs. There was some questions from Alex. Could we go back to the questions? And how you can decide which one is healthy household, and about education, from where to get this data? That was data on Life in Transition survey, the fourth wave, which was taken after the COVID. There is a result of reduction of decline. Let's go back to that table. There were some categories of consumption there. Here, in general, left-hand side variable is a category variable which shows if there was a decline in consumption of some types of products by households. Based on the head of the household with the higher education, we could see the decline for medical expenses, utilities, and some basic food products. We see some real decline here. We can hardly say what it is connected with. why it was for the heads of households with higher education, we don't know without additional research. This is just what we see. This is quarterly data for households. No. This is Life in Transition survey by the European Bank of Reconstruction and Development for a year, yearly data for different countries, but this is sampling for Kazakhstan from EBRD. For which year? Oh, I may be mistaken now. Maybe Ran can remember 2021 or 2022. Okay, thank you. The question is from Ramazan Adosov.
Small declines in spending and business activity. In other words, have you looked at the extent of digital infrastructure, its development?
So, in principle, this is possible and maybe expected. It's just we don't really know the degree of infrastructure development within the spatial units. So that's something we don't know simply.
But you could look at the number of point of sales in a block.
That's right.
That would be, no?
So we do see the number of points of sale. The point is, so digital infrastructure might be then, let's say, the broadband connection speed in the specific area. If we did have it, then it would be possible to look. So probably in those areas where you have better connection, then you probably might have a smaller decline, but that's just a speculation because we don't know it.
И от Рамазана Досова.
And to Ramazan Naidosov.
Okay, so it's a totally valid point. The spatial spillovers might have occurred, and I would probably argue they did occur. However, we did not explicitly consider the effect of spillovers. But that's something we are planning to continue the analysis. So definitely that's something to consider.
Вы еще сказали, упомянули ограничения на
You have also mentioned the limitation to move from rural areas. They have influenced the yes, as per the limitations limitations on movement between city and village. Really, spillovers should have been limited during the lockdown and be present outside the lockdown. But to actually analyze if it's true or not, or was it true or not, or this the impact of the spillovers. This is the behavioral patterns during the pandemics or something else. Are we looking at the behavior or limitation of the behavior? Here, I think both. If we are looking at the first and the second lockdown, the big difference, there was big difference between two lockdowns. If we talk about behavioral patterns, if we compare, for example, the limitation in developed countries, there are behavioral patterns that when the incidence grew, the population started to isolate more. They didn't hit the supermarkets in that big manner, and then transactions actually decreased in number. What do we see here? The incidence happens, the growth of incidence happens during the second lockdown. The administrative limitations were quite strict during the first lockdown and are less strict during the second one. And the fall of transactions is much less in the second lockdown. As the incidence is higher, as per the behavioral patterns, there should be a bigger fall of transactions, but it didn't happen. So what we see is the main effect of administrative limitations. And to continue this question, Ismaili.
Was smaller than the first. Is it because the decline in the base, the first round diminished it, and the second term already decreased the activity? Или это эффект базы, или это не эффект?
Is it the effect of the base or not? How big is the effect of the base? The effect of the base is partially present. But if we consider what is called the raw data, we can see that after the first lockdown, there was recovery. Maybe not up to the pre-COVID period, but close to it. And the base before the second lockdown, it recovered almost to full. So the effect is not about the lower base, but with the adaptation. And finally, policy-related questions. How much we can use these results, and what is the moral of the research for the macroeconomic policy or for any other policy. So the main is, I would say, how to respond to such shocks from the administrative behalf. And then the administrative limitations impact a lot. And during the second lockdown, we can see what measures have been developed or implemented. I don't remember the details, but there was a certain algorithm, what industries could work and how, and that actually worked. And even though there was a decrease because the limitations were needed due to incidence rate growth, we see that the effect was much less than during the first lockdown. And this experience of adaptation can be used for further shocks. So the second lockdown was efficient as per the trade-off on the anti-epidemiological measures and limitations for like lifestyle. Yeah, during the first lockdown, we had stimulating measures. For example, temporary work restriction, and people got the compensation, but it didn't, of course, slow down this huge consumption fall. And during the second, the algorithm of limitations was much more effective. Alisher, thank you so much for the presentation. We would love to see it as a published article or paper. And thanks for the questions as well. So we have the second article that will be presented by Yulia Andrus, the chief analyst of the Department of Microeconomic Research and Forecast of the Department of monetary credit policy of the National Bank. Yulia has received her bachelor's and master's in Nazarbayev University and also studied in Autonomous University of Madrid and Barcelona High School of Economics. She does the research in macro and microeconomics with a focus on the efficiency of monetary policy in Kazakhstan. Hello, dear audience. We're going to talk about the monetary shock identification in inflation targeting mode, influence of monetary policy on consumer behavior in Kazakhstan. I will talk in short why I chose this topic and why this is so important to identify the inflation shocks. We looked at some literature, and my study has three main stages. First is identification of monetary shocks. Second is the impact of new measure of monetary shocks on micro indicators. That's all about inflation as well. And the third stage is the impact of new measure of monetary shocks on population consumption. I will talk about the methodology and results in each stage. And from the very important, I will use the monetary shocks and shocks of the monetary policy as synonyms. So this is still a relevant topic in the literature. Using incorrect measures can actually hide the connection between the monetary regime and we need to use the exogenic measure that doesn't reflect the reaction of the policy in microeconomic conditions. So the main thing was that the rate changes in endogenic manner that can also very much influence the changes in the economy, and the basic rate is very much impacted, and we can see that the forecast has its important role now. With that, using data standard methodology might not in full analyze the situation. One of the very much used methodology, that's a WAR methodology, and the main results in the dynamics of inflation is the initial growth of inflation and then its fall. That's a very frequent phenomenon, and with WAR methodology it used as a press puzzle. National Bank pays a lot of attention to GDP and inflation, and that means that the basic rate decisions are not done only with the current data, but also with the forecast of how the inflation impact will go. So Romer and Romer has suggested a new approach. This is a narrative approach, so-called in literature. This is manually measuring the shocks based on those data that can be used from the protocols of monetary department meetings. That is quite a popular approach. And in my study, this methodology allowed me to look at the macroeconomic macroeconomic indicators. In this table, you can see the main studies that I based my paper on. The first one is very important for the methodology. Romer and Romer suggested to use a new measure of monetary shocks. The results were that the effect of new measure of monetary shocks on GDP and inflation are significantly more pronounced and appear with a shorter time lag compared to the results based on the traditional approaches to measuring the impact of monetary policy, such as VAR models. And there are others who use this methodology. Klon and Herden, they used also the same methodology, had the same conclusions. Champagne and Sekel also used this methodology to analyze the monetary shocks in Canada. And nevertheless, they use the basic methodology because Canada has a slightly opened economy. So they looked at the currency rate, exchange rate level, and his Federal Reserve. So they received also similar results. And the particularity of this methodology is that we have the range of monetary shocks that can be used for the impact of the monetary policy on other indicators. So, for example, Batsukh and Grashani, they use a new measure of monetary shocks defined in Beckers in order to measure a State Department local projection model. And these results show that the effectiveness of monetary policy decreases during the periods of high debt and burden of the population. Moving on to methodology, I will stay a lot on this one. The first is change in the base rate measured in the frequency of meetings of the rate, the value of the base rate adopted at the previous meeting. And this is not depending on the macroeconomic changes. So the peculiarity is based on the forecast indicators that is also presented by the Green Book that is prepared by the forecast team of the bank. And the data was used from the final slides of the bank forecast department. You can see the formula for monetary shocks. So subscript them. This is the meeting of the bank, and that is taken from the schedules of the forecast rounds, and that is important. I will talk about that later. The formula for Kazakhstan is a bit different from the Romer and Romer specification, like with Canada. I thought it was interesting and important to do this, to include this data, and the members of the committee might pay attention to these indicators at the present moment. I also tried to put in the value rate of ruble and other rates, but the results didn't change by far, as the members of the chair are presented with certain rates. If J is equal to -1, then we use the historical number for the previous period. If it's equal to 0, that's again something prepared by the focus team of the focus department. This is for the first and second quarter, depending on the date of the meeting ahead. So it can be a certain rate. So we consider here level as well as the meaning of the forecast. Also, the external shocks were considered geopolitical shocks, and single rate decrease, like during the pandemics, was excluded from the timeline because it actually deviated the estimation. I used the Green Book, even though this data was updated over the time. Taking all this, the residual can be taken as a shock, of the economy, not depending on the macroeconomic situation and the one forecasted in the future. You can see here the results of the shocks and decision-making on the base rate. The increase in the inflation forecast by +1 percentage point translates into increase of the base rate by 0.47. A change in the forecast for the real GDP growth by +1 leads to a decrease in the base by rate by -0.035. Here I want to mention that the resource of shock can be the personal forecasts of the members of the department and the target and the audience. The policy can also influence the shocks. You can see the aggregated shock and the base rate, the monetary policy shock given forecast values. That again proves that this shock is the base rate that is clear from the impact of any changes of macroeconomic conditions. Looking at the second stage, this is using a new measure and seeing how this impact of monetary policy shocks on the economy in VAR model can happen. We can see here the lack of polynomial and the price index and a new measure of shock as an exogenic are the oil price and COVID shocks and geopolitical situation. So VAR can have other other indicators, but with the monetary shock estimation, this information has been considered, including the additional indicators will not influence the estimation itself. At chart 3, you can see accumulated impulse responses of macro indicators to monetary policy shock, +1. We can see that on the next slide. At this slide, we can see the impact of monetary policy shocks on the economy in the VAR model. So in the impulse responses using a new measure monetary shock. So we can see here when replacing the new measure of monetary shock with the value of the base rate, the price effect puzzle becomes much more pronounced. As I said, that behavior very often can be met in the literature, and this is known as a press puzzle, when the inflation is slowly growing after the rate grows, and then it starts to step-by-step decrease. And here I can forecast that if we look at the third and fourth forecast data, that can actually disappear. If we look at the impulse responses during the new measure with using the base rate, we can see here the much more vivid decrease. And the results using the new measure show that the shock increase by 1% leads to decrease by 0.2. That's the maximum decrease.
The next stage is using the measure of monetary shock mitigation with the effect of the monetary policy, which is published by the Statistics Bureau. We used local projections methodology presented by Jordan Banky in 2005. That methodology is to calculate linear regressions for each time horizon after shock, where beta H is the shock coefficient and the impulse responses in local projections is the sequence of beta H coefficient ratio for each H and vector Y. We can look at vector Y as level of inflation for food, non-food products, services, and for the clothes, furniture, transportation services, tobacco, hobbies, entertainment, education services, and healthcare services. XT for the controlled variables, including ZT minus 1, which will include logs in YT variables. Here, in fact, since the model uses the measurement of the monetary shock, which takes into account the current and expected condition of economy, economic macro variables are not mandatory. Here you can see change of shock by 1% affecting the inflation without any other variables except for COVID shock and geopolitical situation. This graph proves that the calculated shock is the clear reaction of base rate to the economic conditions. What is important? This is a minimalistic model, and we see the logical response of inflation. It confirms that they use shock responses to the shock as a base reaction of the base rate. The received dynamic complies with the impulse dynamic we received with the VAR model. We expect a decline in the second and third quarter after the shock, and by the 8th quarter, the shock effect becomes statistically insignificant and is weaker. Here, the next stage is to analyze reaction of the main components. Sorry, wait. According to results, the highest sensitivity in the change of monetary policy, the consumption, the services can respond more significantly in the subcategories, more significant decline in restaurants, entertainment, and education areas. After the positive monetary shock, the consumption and food area are suffering more. This dynamic can be quite logical and correspond to the decline in demand for more sensitive categories like entertainment, restaurant businesses, and so on. Also, there is decline in consumption of non-food products by 4.3% with different dynamics in different categories. Also, there is reduction in the first quarter after shock. It can be connected with its complementary effect to the acquisition of residential premises. The next is assessment of impact of DCT on consumer behavior in states of debt burden of the population, mostly in business cycles. In Kazakhstan, the consumption can be interested in terms of debt burden of the population. In the recent years, we can see growth of the loan indicators for population. The condition of the economy has the formula shown on the slide. The difference from the equation on the previous slide is accounting of the IT minus 1 variable, which would be equal to 1 during the period of the high debt burden of the population. The level of the loans would be determined by deviation of the total attitude of the population to the situation. The impulse responses were calculated on 3 wide categories of consumption: food, non-food, and services consumption. Here we talk about volume of consumption. The results show that in the conditions of low loans for population, the response is more expressed, especially for the food and non-food products. You can see the response compared to the basic specification. The high level of loans can reduce the efficacy of DCT compared to other countries. What may happen theoretically, we expect that increase of the base rate would reduce consumption. However, with the relatively high and long debt burden. This effect is mitigated, connected with the reduction in the income of the population, and it had decline in consumption in the previous period. One of the potential channels which could explain with more details response in context of Kazakhstan. This is a lending channel, which is called home equity channel. With the reduction of rent, the prices for real estate can grow, increasing the cost of assets of the households and expanding the abilities for lending for them. But population can be not ready to take new loans, and the banks can reject the applications more frequently. Transmission of the monetary policy can be less efficient in the conditions of the high debt burden. As I said in the beginning, assessment of impact of monetary shocks is one of the common topics discussed in macroeconomy, but the results can depend on the methodology used. For Kazakhstan, VAR methodology used shows that the results of this T effect were lower in dynamics than observed in this research, and one of the exploitation is that narrative approach can use the VAR modules without taking into account the forecast values, and the received number of shock is not exogenous. The results of this research have shown two significant differences. The impact of the shock on GDP and inflation is more significant within 2 years after shock. It is more obvious, and there is reduction in the disposal, and we see also that shocks of monetary policy have some impact on consumption of the population, and this impact can be reduced with the quite high burden of debts of the population. Here is the list of references, and that's it from my side. Thank you. Thank you, Yulia. I have a short question for you. Please show us the slide number 6. The ratio with the previous period rate is minus 0.8, right? Slide 6, please. Yes. This means that the current period rate is 92%, consisting of the rate of the previous period. Are you talking about the ratio for the base rate? That's right. 92% means that the shock is measured through the relative as to the previous decision, right? The shock is, we look at it not in general as to the policy, but as to the policy of the previous period, and in the we perceive the previous period as a policy, right? So this monetary rule is perceived in the context of previous period. Right. We include, in any case, the meaning of the base rate for the previous period to get some impact in revert. If this rate is quite high, the committee may not increase it to the extent as they would do if at the moment the rate was not that high. In general, if we speak about coefficients, about ratios, the authors of other researches do not interpret the constant value or ratios, because the purpose of this regression is separation from the base rate of the components which are predictable within the current macroeconomic situation and the expected one. This coefficient supports the authors of other research, but they do not pay too much attention to its interpretation here. For us, it's more interesting to consider interpretation as to the Committee of Monetary Policy to respond to changes in the forecasted values. Thank you. Also, another interesting ratio is the one which is not paid attention to, is the unemployment rate. It is here very important. Would you be able to comment it somehow? Yes, in fact, the level of unemployment in the previous period, in the previous month, is statistically significant, but it complies with the theory in general. I would like to draw your attention to the fact why this coefficient can be so high, because we keep in mind changes in the macroeconomic situation is not significantly changing factor. The unemployment is not changing. It is changing at a lower level compared to the changes in the main, not main, but other macro indicators. We cannot imagine a situation when during the year we have significant increase or decline of unemployment level by 1%. In the magnitude, the response can be conditioned by some minor changes in in the level of unemployment. It is possible that in macro indicators there are more significant changes. That's why the response is so high. But in the interpretation, if we try to interpret this coefficient, we need to keep in mind the constant values. It is quite high, as you can see. So if we imagine a situation when forecast values are not changing, the interpretation of the expected base rate, we need to keep in mind the constant value and level of unemployment, because these variables are not differences. So if we add all these coefficients, then it will be close to 0. And the negative coefficient and the unemployment level is not that significant in this sense. As for the economic and social interpretation of local projections, what behavioral factors can explain abnormalities in responses of different consumption components? I would not call it abnormalities, but I would say some differences. But nevertheless, you have segregated some sectors which are funded in the banking sector. Indeed, I have segregated some sectors. We are limited in data again, but we can see reaction of other categories of consumption. I would not call these abnormalities as well, but this means that our population has rational behavior if we see the significant, the maximum declining components of consumption, which can have not that impact in our utilities, for example. If we switch the results to ourselves, the increase in base rate causes higher expenses for consumption. What we reduce, first of all, the consumption of services, then non-food products. In case of food products, I would not interpret this something abnormal, but mostly it is explained by the consumer behavior being changed and adapted, and there is some replacement effect, and the population prefers to consume more at home because they have more resources, because of consuming less expensive services, less spending money at restaurants and for entertainment. Okay, thank you. How strong is the dependence of results on the specification chosen? It would be good to understand here that there's a double-stage process in a way. Yes, indeed. It's a double-stage process. First stage for the first and for the third stage of research is impact on GDP. This is interpretation of shocks. As I said, I tried different specifications and models, but I left the basic one like the other authors do. What was used in the basic specification, Roma is using the forecast values for the first and second quarters ahead with the historical data for the last quarter. I will try to include specification for the third and fourth quarter. I will need to review all the presentations, but I expect that maybe price puzzle effect would be excluded. As for change of the specification, I added price for oil and the real ruble rate. I tried to add the rate of central bank and Federal Reserve System, but the declines are quite small and statistically insignificant. Same was observed in inclusion of these variables in change of the base specification. Statistically significant were the variables in the base specification, which explain it better with the previous values of rate and forecast values. Thank you. Murat Temirkhanov, question. You said that the actions of the National Bank not meeting the expectation of the market have the certain effect. The actions of the bank which do not comply with expectations of the market, she repeats. Yes, we mentioned the impact of the level of prices or inflation, or it can be interpreted as a decline in the level of prices as to the potential level which would be without the shock. I think it is not about this, not like a surprise for the National Bank, but surprise in terms of increase of the rate, having this disinflation in effect. Okay, I understand the question now. So, yes, it seems to be true. We separate roughly the monetary policy which is conducted by the National Bank from what the market is expecting. If we do not do so, we do not account for what the market could respond to in terms of its expectations. These are some unexpected changes in monetary policy which theoretically impact the macro indicators, including consumption. For example, if the shock is equal to 0, that would mean that the rate was changed only according to the economic changes which the National Bank observes currently and in the future. The shock is a policy conducted to reduce the inflation rate. Thank you. We have a question, not digital one. Yulia said that you excluded the period connected with lockdown, right? Yes, right. The period of increasing the base rate by 2020. I remember that this period was connected not with the lockdown because there was no COVID in Kazakhstan. That was the response to the prices for oil, classical shock, I think. Maybe it influenced your outcomes, of course. Yes, I understand. However, technically, this observation is a significant one. Technically, I had to exclude it. But this is a classical shock of impact. But was it the policy conducted at that moment, response to the change of conditions which is impacting the exchange rate and so on? This was the response of the National Bank to the significant factors. It was not the COVID, which could be another factor. Okay, I will try to keep this observation. Maybe you can play with this rate because that period was not connected with the COVID yet. Okay, I will try to do so. Thank you. Any other questions? Yes, please. Thank you very much. Yulia, thank you so much for your research. My question is, does the National Bank have any acceptable level of the debt burden for the population? Did you ever calculate it? Maybe it was done as an estimation, but not in the paper I'm working on, I assessed the deviation from the trend to assess a relatively high level of debt burden. It doesn't mean that the population is under the higher burden. It means that it has higher burden than before. And my second question, I did not understand about the model you used, the unemployment rate. From where did you get those data? If we refer to the Statistic Bureau, then I have doubts about this data. And you said that there are some variations in them. You mean data about pulse on consumption? No, in your model you use the unemployment level. From where did you get that number? I used the unemployment rate not based on the published data before 2010. I divided the number of unemployed people estimated by the workforce. I had some changes in this indicator compared to the data published before 2010 from the Bureau of National Statistics.
Yes, not the number that is published, 0.6, for example. I took the unemployed and the labor force, and I divided these two numbers. In dynamics, there are some small changes that might be tracked. And that is also explained by the theory during the COVID itself. We have a very small changes. That's why the coefficient during the translation to the basic rate, it is so big, because the changes are so small. But they do appear. If we look at the dynamics, so we take into consideration the dynamics, right? Not just the volume, the volumes. We're looking at the dynamics of this indicator that actually matches this theory. Yes, the changes are small, that's true, but it corresponds with the dynamics of other macro indicators. The impact is not minimal. That's not what I want to say. When it changes, let's imagine that we see the coefficient on the unemployment by 1% unit. And we can see the data published tomorrow once we wake up. That the unemployment rate changed by 1% points. Happened something that we didn't expect. We were shocked by this fact. But nevertheless, these small changes, so marginal, they still correspond to the dynamics of macro indicators, to GDP, to decision making, to general, to consumption, for example. Any more questions? Maybe we answer the debt. Yes, no, not about this. So the general question. Yeah. Thank you very much for your presentation. I like it very much. But it is not leading us where it should. And if we talk about the debt, it is very much about the economy stability. When we see the flow from price puzzle into the consumption rates on the effects of consumption of different branches of monetary policy. It comes from the monetary credit policy into the financial risks, and you lose me. You lose the person who is the consumption rate fall. Doesn't mean that the instruments, the shocks, responsible for the price. And my personal suggestion is to stay in this route. When you go away to the leverage and macroeconomic policy, that's absolutely different topic. And the Department of the Financial and Forecast Stability, we have this leverage. We don't have acceptable, non-acceptable. There is high and small. And what is debt burden? What is leverage? We need to identify what is that is the number of credits, the volume of credits, monthly payment on credits. There are studies of foreign countries, and there is no one single unique recipe, but there are studies from different countries, and they identified, yes, do we have this? Yes, in short, we have micro production instrument, 50%. If you have the volume of payments on the credits is more than 50% from your monthly payment or salary, and that can be your actually hardness or burden in your life. Thank you, Yulia and Alisha. Yulia wants to say something on the important question. No, I just wanted to answer the comment of Jandas. I will start with the stability. That point in my research was not the stability. I just used it to actually look at this. So one of my research interests is influence on the consumption, and it was interesting. And the shocks of the monetary credit policy on the consumption, and looking at the credit of the households, not to estimate the financial stability. That wasn't done. As per the price parameters, why this happened? Because the objective was to estimate the shocks on consumption. So there are different transmission channels. I also think that the consumption has certain channels that impacted. I read different papers. It was interesting to use this approach, but the final point was, the final objective was to look at the consumption level, and we had to have I couldn't look at this, the compare and at this monetary credit. I hope I answered the comment. Thank you, Yulia. I still have a lot of questions on the price puzzle and on the interconnection with financial stability, not just to you, but to the others. I would like to ask them all, but it's better to do it in the whole, I think. Thank you, dear friends. We finished the session. I want to say thank you for the wonderful questions. Thank you, Yulia and Alisher.
1, 2, 3.
Да? Вот так. Ой.
Зачем? Зачем?
Не в тему же? Раз.
Уважаемые коллеги, подошло.
Dear colleagues, it's time of our final session. It's called Macroeconomic Dynamics in the Context of Price Shocks and Structural Imbalances. The moderator of this session will be the Deputy Head of the National Bank and the representative of the National Bank. Vitaly Alexeyevich has finished the Masters of Al-Farabi University on macro and microeconomics and mathematical modeling, and also Lomonosov University in Moscow. The career in National Bank he started in 1994, and he has led a very interesting way from the analyst department to the deputy head, has been head of the monetary policy, the Department of Statistics, and other. Vitaly Alexeyevich, please start. Thank you for introduction, dear colleagues. I can see people coming and sitting in the audience after lunch. That's the most difficult to hold a session after food. We got a bit tired and we have some interesting things going on. You will not regret staying with us. There will be some discussion topics and problems, and we shall touch upon some things. The third session is called Macroeconomic Dynamics in context of price shocks and structural imbalances. I think everyone has scanned the QR for questions, for asking questions, like Jandos has mentioned, in all languages, in all 3 languages, I would say. By the way, did we have any online questions? Pity, it's a pity, because even those who have been with us online, they are able to ask questions not being in this room. Our third session consists of 3 presentations. We have 5 speakers. Please allow me to introduce them. Alisher Ahmed is a specialist of analytical block of the monetary credit policy. He does the modeling. He is the graduate of Nazarbayev University, financial specialist with the background in statistics and research. The floor is yours. Thank you. Good day, dear guests. Good afternoon. We have the presentation on the impact of oil prices on Kazakhstan business of cycles, an empirical status and asymmetry approach. On the slide, you can see that our economy is characterized by major impact of oil prices on business cycles in Kazakhstan, which forms a big part of our budget. And when oil prices change, this actually has huge impact on our economy. In general, we have to understand the context of previous research done on this. Gadea work of 2016 is a long-run relationship between oil prices and economic growth using VAR and impulse response models, highlights the changing macroeconomic response of oil shocks over time. And they study more than 150 years, looking at the structural changes in economy, such as energy efficiency and technological development. This is an important paper for us because in general, using VAR, they indicate the asymmetry depending on the economic cycle. Next is Solomon et al. Of 2024. They used the threshold VAR, TVAR model that allows to identify the threshold, critical threshold, and the impact of oil shocks. Hamilton and Raymond and Rich works are also important. The impact of oil shocks on economic growth over time, and introduction of the concept of asymmetry of economic response. And Hamilton focuses on the time periods and looks at asymmetry impact, that the negative shocks are more pronounced than the others. And Raymond and Rich have extended this idea. They used Markov switching models on the post-war states, looking at the oil shocks that actually influences the downfall phases, still impacting the unstable periods. On the list is Kachand and Taganidze work, a paper. They use a resource-dependent they use the model that shows the resource-dependent economies are particularly vulnerable to external shocks. Our data in general is made of GDP, inflation, real prices for Brent oil, and real exchange rate USD KZT for oil differentiation. And we have 61 observation from the second quarter of 2009 up to 2024. So first we looked at the seasonal adjustment method. We did this inflation, our and US and the state budget. So we took the first difference, the D-log, in order to have the stationary indicator. For vector models, we used GDP and other indicators, looked at the Markov switching model. Also, we had the regime of monetary credit policy. Some methodology was the usual VAR model that was to estimate the oil prices impact on the monetary policy in general. So in TVAR, that was extension of a simple vector model. But here there were certain conditions on transfer, so it was brand for us. So the model actually chooses by two criteria, Sanskar and minimization of certain indicators and likelihood. That leads us to a certain threshold. In Markov switching model, we have two conditions, crisis and non-crisis, and the model can choose the option on how truthful this indicator can be in certain regime. So that's again integrative process, and we need to see the level of probability. You can see the formula. It looks like our equation, but this is really the one that is using the Markov switching model, switching process. The data is not broke down. We have a certain level from which we can draw two equations. Let's look at the results. That is our first stage. Simple VAR model. We can see the negative shock on the right. Its peak comes to the second quarter after the shock itself, and in a cumulative manner, that will be +7, and on the left we have a positive shock. That is more or less stability of economy when the oil prices grow, and with that we can show that actually GDP is impacted only by negative moments when the oil prices fall, no matter what new economic regime is in place. That's a simple linear estimation without dividing into regime. Then on TVAR, we can actually identify the threshold that was -14%. And I have to clarify, -14%, that is a real change of oil prices compared to the previous factor. Thus, in this model, the decrease will identify the structural gap and the transition. In accordance with such division from 2009 to 2024, we have some critical periods. Here we can also see the responses that have similar dynamics with consideration or without consideration of the crisis periods. So we can see the effect on 3.54 quarters. The Markov switching model on the graph, it's important to see the probability. It's important to see where is economics in the time period, and it gives an estimation on the probability of transition from crisis mode to growth mode. In accordance with our data, that's almost 72%, that the economy being in a crisis will stay in crisis. and quite a high chance, 28%, that the crisis will finish in the previous, next period. So it's also the probability of transition to crisis is 7%, and the probability of continuing the growth period is 93%. Depending on these probabilities, we can actually count the average, and the growth periods is 14.22 quarters, while crisis periods last on average 3.54 quarters.
The mean prices for oil on the Markov process in the crisis period is very close to the threshold value calculated by the vector model, close to -14%. Here you can see our key findings as a whole. The findings prove the significant impact of oil prices on macroeconomic stability in Kazakhstan, and this model has allowed us to identify linear and non-linear dependencies and assess symmetric impact. Negative shocks have a significant impact on GDP, especially during periods of crisis. Positive shocks have no statistical significance, and these findings correlate with the theoretical expectations from papers, specifically Hamilton, Raymond, and others, confirming the key role of oil shocks as drivers of economic fluctuations in the resource-dependent economies. Also, the model has allowed us to specify the threshold dynamic and decline of prices by 15% compared to the previous quarter. Also, you can see that in the crisis period, 0.54 pp are cumulative shocks after a year, and we determine the shock as we look at a line. It is about 10% of changes of oil prices. We call it as a shock. Here I finish my presentation. I'd like to answer your questions now. Thank you, Alisher. It's a great presentation. It's good that what is the interpretation of Hamilton? Why positive cycles, apart from stable growth, why positive shock is not that notable? Maybe there are some other tools which can hide this shock somehow. Thank you for your question. First of all, I would like to make a statement that quite possibly that small number of observations is impacting this only 61, and when we divide it by the phase of growth or decline, it is even lower. Maybe it is a limitation of the model itself. Maybe it is not capturing the weak but economically significant impacts. On the other hand, the economic growth can have neutralized the positive growth, because negative income can make the exchange rate stronger and push the decline or reduce the competitiveness of our production facilities. And secondly, there is no direct inflow of oil revenues due to accumulation in our fund, which should work like this. In ideal situation, there is no direct shifting. Thank you. We have 3 questions. Please use slides or microphones. In the hall, please be active. The first question from Alin: how did you determine belonging to the phase cycle of a model, or identification of phase can influence the shock of oil prices? I'd like to answer it in this following way. We are not determining belonging to the phase, but we call them the growth or crisis phases, but technically these are 2 modes of the model, and each has its own definition what is crisis. And in the worst period, it lasts not so long, and you can see in the findings that it's only 3.5 quarters, so when for many people definition of a crisis may mean a long-term decline in business activity. Can the choice of method influence the factor of oil price changing? The choice can influence the phases of economic growth, and the impact will be statistically significant with a more fine approach. I just expect so. Okay, thank you. Next question from our guest from Azerbaijan.
Oil for the Kazakhstan that below this price it has negative impact on GDP, and above this it happened positive impacts.
In our particular research, we do not aim at a certain level of prices because we are targeting the dynamics itself. And in our case, we are measuring the decrease relative to the previous quarter in real terms. That means deflated, because we have an assumption that economies are able to adapt for certain price levels. Also, it is important to mention the costs of production of oil in Kazakhstan, which I'm not certain right now. But most important is to consider the quarter-on-quarter change instead of levels, I believe.
Thank you. Next question. To fight the oil shocks, counter-cyclic fiscal policy is used. So we had pro-cyclic policy. How could you account this policy in your model? Fiscal policy is accounted in the Markov switching model. It is present in the equation. Sorry, I have dissonance. What is the question then? We accounted for it in the Markov switching model, the policy, fiscal policy in the government expenses. So you didn't divide it for pro-cyclic and counter-cyclic. We didn't have the target to determine behavior of fiscal policy, but it is present in the equation. I would like to explain my question. Counter-cyclic policy is using it in the following way. We have a national fund. When there is a high price for oil, we accumulate money. When the price for oil is declining, we use money of the national fund to smoothen the shocks. When we have higher prices, we had pro-cyclic policy. Instead of saving, we used last year revenues 1.7 trillion tenge, less than used by the national fund. You told about expenses, but it is not mentioning if it is procyclic or contracyclic, but they impact, they shock significantly like the economy is influencing them. In the future, how could we account that the government or state expenses, they are growing from year to year, but they don't show expenses of the contracyclic policy? In general, counting of state expenses in Markov switching model, if you look at the slide with the modes, what was the slide? I think it was number 10, if I'm not mistaken. It allows to exclude one of potential crisis periods in 2022 somehow. We don't observe the growth probability on the decline stage here. Maybe accounting of state expenses has allowed us to smoothen it somehow. Because 2022, if I am not mistaken, there were some declines in oil too. We have one more question. The results of study have shown that negative shocks have more impact on GDP than positive ones. Can you interpret it as the negative oil shock is a trigger of recession? Once again, if we refer to the last graph, it shows us probability. For us, it is not an opportunity to say it is a trigger. It is a statistical estimate which keeps into account. It has no political and economic implications. It is based on minimization of the forecast errors. It can hardly be considered as a trigger in terms of policy specifically. 14% decline in oil prices does not mean that we need to take up the folder and take the anti-crisis measures. This is my personal opinion. This is the statistical assessment, and risk management should be not so much related to each other because it's hard to make decisions at this level. Alisher, thank you so much. It was a very interesting presentation. Our conference is very informative and intensive in terms of narrow and specific topics. I have a very general question in a way. Is that difficult to conduct a study, research, and build models in general words? And in particular, is it hard to validate models? And is it hard, or what difficulties do you face in your work when you access data, the quality? What would be your comments on that? As for the data quality here, we have the only problem about the data quality that GDPs from 2009 have a different structure and a significant trend. That's why we use this data and we don't take earlier time frames. As for validation and data quality and different transformations, I think any statistical expert is facing such conditions. Preliminary preparation of data is required in any case, and one of the difficulties in economic data is presence of outliers which cannot be controlled through the dummy variable, which causes violation of statistical expectations about the model. And as a rule, there is a break in perception of the normality of balances. In our specific case, we had a problem with heteroscedasticity of balances, especially in the crisis periods. So we had to pay more attention to that. But again, here there is remark that the vectors of autoregression of heteroscedasticity is frequently extrapolated on the equations which are not target equations for them. In GDP equation, we don't see the heteroscedasticity, but also it's quite possible to give more robust assessments or estimates on impulse responses. We used organizations, Haletsky, to provide the estimates relevant in the breaks of these main assumptions. Thank you. Colleagues, do you have any other questions? No more questions? I don't think that there are no more questions, but the topic is very specific, very narrow. Thank you so much, Alisher, for your presentation, for your answers to the questions. Let's give a round of applause. Our next speaker, there are two speakers. Aygerim Razbayeva is an employee of the Department of Center of Research and Analytics of the National Bank, holds a PhD in economics. She has experience in research and macro modeling and monetary policy, including the construction of DSG models. She worked as an associate research fellow at Cardiff University, UK. Aygerim's teaching activities include Cardiff University, Kazakh British Technical University, and Narhos. And co-author of Aygerim in her paper is Sabit Hakimjanov. I was reminded he is advisor to the chairman of the National Bank of Kazakhstan, holds a PhD in economics, a candidate of technical sciences, worked in the academic field both in Kazakhstan and abroad, worked in business, though we did not mention it. Now, at the National Bank of Kazakhstan, he worked as director of the Financial Stability Department, as well as the Department Center for Research and Analytics. And their presentation is going to be in English. Aygerim, the floor is yours.
Today we are going to present our DSG model for fiscal block for the calibrated to the case of Kazakhstan. So what is a DSG model? This is a dynamic stochastic general equilibrium models. So dynamic stands for the several periods. Stochastic, we have a government spending shock. General equilibrium is, we consider the whole economy where we look at the market interactions. So today's the main purpose so the main research idea is that we look at the fiscal block. This is the first benchmark model for the fiscal policy for the Kazakhstan. So what we do first is we look at the trade-off between current government spending and accumulation of the government debt. So we look at the welfare implications and also for the dynamics of the economy. We make two assumptions. First is that government spending consists our government transfer or fiscal transfers. We outsize its role, so the entire government spending is the government transfers. This is our first assumptions. Why we do it? Because the data states that 27% of the transfers is actually the government spending. The next one is that we divide the households into two types. One is the recurrent and non-recurrent households. So those who has access to credit markets, yeah, and those who doesn't have it. Those who doesn't have it, basically, they consume their entire income in certain periods. The data suggests for Kazakhstan that the share of these credit-constrained households is very large. So that's the main two assumptions. Today we are going to present two research questions. The first one is we look at the impact of the government spending on the whole economy and especially on the household welfare in a DSG model, and that will depend on the source of finance. So the government spends, and the question is how they finance it using the new debt, taxes, or the oil revenues. Okay, we look at the implications. The second research question is we estimate the fiscal multiplier, and that will also depend on the source of finance. The literature is very, very broad. So here we classified the two. One is that DSG model with fiscal block. So the most advanced countries, they have their fiscal DSG models, like Norway, Spain, and Australia. So the model we are going to show today is the first fiscal DSG model for the Kazakhstan. Since this is a benchmark model, it's subject to the further modifications. Second is that literature states that the total government spending multiplier is usually larger than the fiscal transfer multiplier because those are affecting the both production and demand and supply side. But fiscal transfers only affects the demand side. And hence, transfer multiplier, spending multiplier is usually smaller. Our model structure is quite standard. We have 4 types of agents residing in the economy. We have a central bank doing the monetary policy, government fiscal policy, and we have 2 types of households, credit-constrained households and credit-unconstrained households. We also have domestic producers, especially we have oil producers who exports all their oil production to the national fund. And national fund transfers part of their income to their budget. The model is quite standard, and the households, they receive income from the domestic firms, and all of them are paying taxes. So this is a key feature. So which one I didn't mention yet is that we have 3 types of taxes. We have lump sum tax, VAT, VAT is a consumption tax, PIT is income tax. We have national fund from the fiscal block. We have 2 types of firms, domestic firms, those are monopolistic competitors. We have final good firms who are aggregators. They operate in a perfect competition. We have a central bank, so this is NBK. They operate according to the Taylor rule, and we have UIP equations. We also assume that foreign economy is quite exogenous. Let's now move to the model details. So first we consider the households. Those has access to the credit markets. So they maximize utilities, so we consider their problem, and where they get the utility, they are from their own consumption, and this utility from the labor. But they are financially constrained, that's a budget constraint, it's that long equations. On the left side, we have expenditure, so households, they consume CTR, they pay the VAT tax, TAU-TS, they buy government bonds, BT, and they pay the lump sum tax, big T. How they finance their expenditure? Because they supply the labor to the firms, so they get wages, and they pay the income tax. Since they own the firms, they receive a constant dividends, DT. Households, those who has access to financial markets, they buy both government bonds and foreign bonds. These are problems for the non-recurring households, those who cannot access to the financial markets. Their utility problem is quite similar to the previous type of households, except that since they don't have access to financial markets, they consume their entire income in every single period, plus they receive help from the government, so that's the government transfers. The optimal condition for both households is equation 1 and 2. Because our model is dynamic, so we have 2 conditions. We have to decide how much to consume, how much labor to supply, and that's governed by the equation 1 and 2. The third equation, this is where we determine our real exchange rate. This is a market clearing condition for households, which shows that we have two types of households, recurrent and non-recurrent households. And those CAR is a share for each of them. Households has also a static problem. We name it as a static, but in case the household consumes two types of goods, domestic goods, CTD, and import CTF. And the omega, it's a home bias, so we set it to 0.6, so 40% of the household consumption is imports. That's our assumptions. And when the household maximize their total consumptions, we derive the optimal demand equation for imports, so how much they want to consume imports and how much they demand the domestic goods. That's equation 6 and 7. Equation 8 states that the CPI price level is a weighted average of domestic goods plus the import prices. So this is a consumer basket. We have final good producers. They are aggregate of the domestic goods. As you see on the equation 9 on the right side, we have J types of intermediate firms, infinite number, and these are just aggregates. The domestic intermediate goods producers, so they are monopolistic firms, but we subject to the cover pricing rules, so they cannot set the, part of them cannot set the price, part can, so we minimize costs, and we get the optimal equation, equation 14. So this equation states how much labor demand how much labor the firms demand. And the equation 15, this is the profits for these firms, which is received by the households in the previous sections. As we said before, this is a dynamic problem, so households has also dynamic problem where they maximize their stream of profits, and as a result of this optimality conditions, we get Phillips curve equation 17. So what the Phillips curve says is that inflation today depends on expected inflation, also depends on past inflation, and plus the marginal cost. That's the idea of the Phillips curve. Now we moved to the main fiscal block. So we have a government and they have a budget constraint. So in the left side, it's the expenditure. On the right side is the income. So the expenditure includes government spending, which is the government transfers. And because in the previous period they issued the bonds, now they have to pay the interest rate back. Now how they are going to finance these expenditures, they have 5 sources of financing tools. They get lump sum tax, they get VAT consumption tax revenue, income tax revenue, they issue new bonds, VT, and they get transfer from the national fund, where Q is our real exchange rate, TR is a transfer from national fund. Then we have a government spending rule, which we assume exogenous. Now let's consider the different fiscal regimes. So these equations are actually feedback rules. So it shows how the government responds to the whatever is happening in the economy. So we have a rule for each tax. They are quite similar in the structure. They depend on their previous level. Yeah, if it's tax rate, it depends on the previous tax rate. Plus, they depend on the level of debt. Okay, actually, the deviation from steady states. Here, the parameter size is the most important parameter. By including them or setting 0 or not, that's how we manage how to finance the new government spending. If, for example, we have a new government spending, want to finance by VAT tax, we make psi-C positive. So those parameters are governing the regimes. We have a national fund block. So equation 23 is accounting equations. So national fund is every period is updated by new oil revenues and transfers goes to the budget. Equation 24 shows a transfer rule similar to the previous tax rules, and it also has the same logic behind. Central bank, we assume that they follow the Taylor rule, means that if inflation is higher, the central bank increases the interest rate. Finally, we have a market clearing conditions. Equation 26 states that total GDP is a domestic GDP plus oil revenues. And equation 27 is a balance of payment equations, which closes the entire model. So these are our parameters which we calibrated to the economy of Kazakhstan. Now let's go to the main results. So in this graph, we show the transmission mechanism of fiscal transfers. So if fiscal transfers increased by 1% of GDP, what happens to the entire economy? This is a model where additional spending is financed by new debt, oil revenues, and lump sum tax. So how the story goes, government increases the transfers. Those transfers are received by households who has not access to financial market. So they increase their spending. Since they increase their spending by our model structures, they reduce their labor. Next, how the government finances this new spending? They issue the debt. So debt level rises. But those households who has access to financial markets, they basically lend the money to the government. Yeah, so they now have a less income, so they reduce their consumptions. So this is where the distribution of income goes. So when the government wants to finance their new spending, they take it away from the, let's say, rich households and redistribute to the poor households. Okay, that's what's going on here. Then total labor rises, so we have more production, so GDP rises, but non-oil GDP rises on the impact, but then it goes down to the negative, okay, it decreases. Real wage also increases because now firms demand more labor. And the real exchange rate here appreciates, yeah, so, and then imports rises. So what is the conclusion from this graph is when the government increases their spending, we have high inflation, exchange rate appreciations, then high inflation, real exchange rate appreciation, and rise in the real wage. Here in the table, we present 5 different scenarios we are going to look at today. The scenarios has to do with how to finance the government spending, additional government spending. So we have these combinations. And those combinations are governed by these parameters. Now we are going to present our first results. So the question is, what is the optimal way to finance the new government spending? One way to look at this problem is look at the fiscal multiplier. So as the graph suggests, at the impact of the shock until 1 year, all the multipliers are exactly the same. But then it differs. This is also confirmed by the result of the literature. Okay? So after 4 quarters, they start to diverge, especially for VAT, PIT taxes. We even have a negative multipliers. Here I also show you a table. Yeah, so the main point is we look at 4 quarters and long run. As we see from here, if our priority is the total GDP, then it shows that better to use the oil funds. But if our priority is non-oil GDP, then better to have some combination of lump sum tax and debt. So it really depends where we look at and what is our priority. Next, we look at, from another second perspective, is we look at deviation from steady state over 10 years. after the shock. So the red ones are the negative values and the black ones are the positive values. First, what we observe that there is a redistribution after the shock, because we take like money from the rich household and distribute to those who does not have access to financial markets. Yeah, so there is a as you see, negative for the consumption for Ricardian households, but positive values for their labor, and other way around for the non-Ricardian households. So this is what we confirm from the literature. Now, if you look at non-oil GDP, it says that it's better to finance through lump sum tax and debt because it yields positive results. But if we use the oil funds, non-oil GDP is going to fall. If you look at the last column, which shows the inflation, so one observation is that if the government increases spending, we will have inflation. The question is, which has a moderate level of inflation, is that when we transfer with oil funds. And this is because oil funds is just new money, yeah? We don't take away the money from the households. So they have a less impact in terms of inflation. So conclusion is, what is our, again, priority? Inflation, non-oil GDP, and also, by the way, national fund depletes by 5%. So if you increase the GDP by 1%, national fund decreases by 5%. Import increases by 1.5%. So this is our result. Now, from the third perspective, we look at the household's welfare, quite standard in the literature. So household welfare, we have two tables, but the second table, so these utility numbers are unitless. So it doesn't really mean anything. We just need to compare them. In the second part, we compare to the benchmark model, our first model. So the red, which is highlighted by red, is the negative values. So if you look at this table, probably the most optimal policy would be use lump sum tax and debt combination that yields the highest welfare for the households. Otherwise, the other three using oil funds, VAT and PIT taxes, they yield negative, less utility. Okay, so highest is generated by lump sum tax and debt. Sorry, it's just our conclusion page is just gone. Okay, I will just, here we are. What we have done in this research is that we have a new government spending. Question is how to finance it. We looked at the 5 scenarios. 2 is a combination of lump sum tax and debt. Third one is the oil. 4th is VAT tax, and 5th is PIT tax. Now the question is, which one is the most optimal? It depends where we look at in terms of fiscal multiplier, in terms of like short run, or we look at the long run, or whether we look at the household's welfare. So answer really depends is what is our priority. So that's what we conclude with this research. Thank you for listening to our work, and we are welcome for questions.
Thank you, Aygerim. That's a session of questions and answers. Those who thought that wasn't enough data on the previous presentations, I think here we had a lot. I, as a moderator, will ask first. So these 5 scenarios were chosen because of the comparison effect on the well-being. Why we have these 5 scenarios? Why you have chosen them? We wanted to see the combination. 40%, we looked also at the budget. For example, now we have a lot of oil funds that finance the households. All scenarios with all different indicators. So that's all impacts welfare evenly. Yeah, it influences differently in short-term period. So in the previous slide with the table, you can see the same distance. Only first and second scenarios are the same, but that is the maximum welfare. And 3 and 4, this is where the custom is actually highlighted. Here, the last one, the W is the welfare. Yes, welfare as whole. So that means that all scenarios are coming with 1. So it should be labor beneficial. What is the optimal? No, Vitaly, we just needed, yes, the fiscal block consists of stock variables, and the rates and the tax policy, they are also part of the parameters, and playing with these parameters, the whole system is very flexible. You cannot make it stricter or increase it with the debt. The debt comes to the steady state. So that's very strict. And there are a lot of equations that actually prove this, because tax rates increase when the debt is higher. So all these 3 equations are the same. And that's for the foreign debt. It's very flexible, but playing with these parameters, you can have a financing mix and change it a little bit. Even though the debt matches during this period, these quarters, we have the correlation on how the debt increased, how the tax increased. In general financing, it doesn't change. We just wanted to see how much it will influence the welfare. That's not the objective. It's just to see the numbers. So we understood how it was, and it was kind of check. But by the welfare, we can see that's using the national fund by 5%. Lump sum tax is an abstract indicator, except for the confiscation of the property. We are comparing 3 tools: VAT, BAT, and the national fund, the lump sum tax. It has some share in all 3 scenarios. We can get rid of it, and the results will be the same, but the best will be VAT, and less preferable is PAT, etc. So we are just measuring the steady state because we fix the debt. That's 40% of GDP. It increases, decreases, it equalizes, but then comes, and the national fund doesn't match. And you can see in the previous slide that by 5% it decreased in this average scenario.
And because of the decline in the national fund, the financing from the national fund for the state expenditures goes down, and the well-being of the poor households is justified by that, and this causes decline by the poor households, has growth in consumption in the first period, in the first 10 periods, then it declines too. So here you can see the trade-offs between today and tomorrow. Wait today or let's eat quickly. In the previous slide, you can see inflation. The scenario with the National Fund is the lowest one, but it doesn't mean that we need to choose the National Fund because of the lowest inflation. We import deflation with the assistance of the National Fund through the import, but it doesn't mean this is the best method. Inflation is a individual criteria. The right criteria is well-being, welfare. We want to demonstrate choosing the right criteria. Thank you. I got it. Colleagues, we have few questions. Please display them on the screen.
What is the biggest challenge facing Kazakhstan's fiscal policy?
Смотря на каком уровне, вот сейчас.
It depends on the level. If by the administration we realize that the fiscal policy is something like giving a tool of fiscal policy to someone, we can say, we can advise. In this case, the fiscal discipline should be there to spend less with more efficacy and collect taxes with more efficacy, isolate oil revenues from economy in the national fund. The main role of the national fund is not to preserve for the future, but for not letting the money to deteriorate motivation inside of economy at the moment. If we look in a wide manner and understand that in the reality we cannot conduct the fiscal policy in this way, then the biggest challenge is at the level of community to realize what trade-offs we have between today and tomorrow, what institutes should be controlling the state expenses and control the ways of spending the state expenses, how we should collect the information to ensure its reliability and correctness, because now we see the state expenses going beyond the financial reports and statements when they buy bonds of the national fund funds. So these objectives are compatible or matching the fiscal policy ones, and it's a bigger task. It cannot be resolved with the administrative method. It is resolvable by the efforts of the whole society who try to understand how we should continue living in the next 50 to 100 years. When we start thinking about it, we would be able to solve these problems, I believe. Thank you for your answer. Second, next question. Approximately of what you have already mentioned in your answer.
Welfare function as a policy optimality criterion.
Да, в данной модели.
In this model, the state has only one function: to collect taxes and takes the debt to give this money to poor household, and they spend it immediately because they hand to mouth. We expect so. They do not save. Why we have chosen this model? Because we don't want to create a model where government is destroying completely the they accumulate the collected revenues, but creating a model where government is doing something else means to make more complicated model. For example, we want to create a human capital. It's about education, healthcare. Therefore, we need to justify, create a block which would reflect this human capital, social capital, or make investment activities in the model. It is very difficult, a lot of variables, and the model is growing immediately. It's quite complicated now, but this is the main reason, actually. Although, in fact, it's true. We look at the transfer, and if you add education and healthcare, it will be much more. Though it is not about transfer, but investment in human capital. I'd like to add something, you don't mind. I will say in English.
In general, when we consider different fiscal regimes, the first thing the central banks or government do is to compare the welfare function. So that's kind of a top priority, and this is the practice common in advanced countries, and so we do the same. So that's kind of additional comments on this question.
Thank you. Next question.
Share of households facing constraints in accessing financial services. What is the main factor behind it?
So from my understanding is why we have high share of households who doesn't have access to financial markets. This is because the data, not data, but the survey or maybe even research, which suggests that share of those households in Kazakhstan is between 55 and 95, I think. And we take it as 60%, just following the literature for Kazakhstan. So that's how we justified it.
Sure.
Good. Next question.
Assuming that government spending consists entirely of allocation of wealth. Следующий вопрос. Проводились ли подобные расчеты с изъятием?
Have you made these calculations with the collected money of the pension fund? No, the pension fund did not make calculations like this because it is necessary to create the forced savings in the additional equations and then invest it somehow. And they are invested in practice in mostly 50% inside of the country. And in our model, we didn't have a capital. Our model is without capital in terms of simplification, but in general, I think that results would be similar, except for the impact on the real exchange rate. Strengthening of the real exchange rate will not happen if we do it through the pension fund. Next question.
Effect is a positive outcome, but from a central bank's perspective, wouldn't this typically be viewed as a negative result?
This would be viewed as negative result if it were sustainable, but it isn't. It is only for the first 40 periods on average. Yes, the impact at the beginning is strongly deflationary because of imports, but it also results in real appreciation, and after real appreciation, well, that's basically what happens with our economy. We go from real appreciation, then devaluation when the oil price falls. So from a financial stability point of view and from long-term price stability point of view, financing government spending through the oil fund is not a good idea.
Ну, и последний вопрос.
And the last question from this slide. What is the final goal for Kazakhstan of this project? Don't you think that is a little bit unreal? Here, the main thing was to show the signs of these effects, that using of the national fund is making the welfare less attractive and worse if we don't account only today's and tomorrow's consumption, but for the longer period of time. When you assess the DCF model, when you evaluate the cost or the value of the company, when the shareholders look in the long-term perspective, they invest, they do not spend, they do not borrow money at the level of companies or households. The problem is resolved in the same manner. Why we, at the level of the country economy, should treat the national fund in a different way. This is the main idea. I think we have illustrated it. We have shown the criteria, which is the welfare, which is accounted and calculated in the right manner. There is nothing new here, in fact. We just have shown it with the standard methods. Colleagues from the audience, is there anyone to ask a question?
This very interesting presentation, and it was very interesting to see your results on the optimal policy mix, and especially this distinct results. I have one question. You mentioned at the very beginning of your presentation that roughly 27% of the government spending is related to the transfers. So I'm just wondering whether your research sheds any light how this relatively high share of the transfer in the government spending might be affecting the transmission mechanism of the monetary policy. Thank you.
Каждый раз, когда мы
Every time when we answer a question about the model, and if we hear a question, we always try to understand it, and I always try to understand if I should answer a question about the model or should I answer the question about the real economics which we have nowadays. I will try to answer a question on the model. I think on the economics, you know by yourself, you understand by yourself. The transfer, it was necessary to introduce a rule, and the rule is there. It is not 7%, it's 10%. Transfer in this model is equal to 10% approximately of the national fund size with some corrections. If the state debt is big, the transfer is increased too, to reduce the debt and to reduce the national fund. The pure debt is going to be higher. Why the mechanisms like these have been chosen? Approximately, the rules of the national fund have restrictions for the size of the national fund to GDP. This is a limitation which we come across all the time, but it doesn't work. There is a strict restriction of the transfer size in the form of guaranteed transfer. I don't remember the amount. There is some amount there, but it corresponds to 3–4% approximately of GDP. And it is equal to 10% of the national fund approximately. Something like this. I would like to add something to your answer about transmission mechanism of the monetary policy, if I'm not mistaken. Here in the model, we had the priority for the fiscal bloc. We did not consider the monetary policy and transmission mechanism. We took it as a standard that there is a central bank here. It is increasing the interest rate with inflation growth, and we did not go further into the policy. And in this model, we cannot give you an answer because it was created for the fiscal bloc only. And that's it for me. Anything to add? I am reading a question from Circle. Why debt is not fresh money? Half of emission of the Ministry of Finance is acquired by the bank. It is a half classical credit expansion, because in this economy, in this model, I'm responding on the model, not real economy, because the model has no money. There is a central bank, but no money. The central bank without balance. There is only Ministry of Finance, which is issuing not only 50%, but 100% is acquired by home offices of rich households. And it's not real, but it's enough to show, to demonstrate the processes connected with fiscal policy. If you want to make it more complicated, we can make it more complicated, but we want you to understand first how it works in a simple form. If it seems to you that the model is too simple, it can be complicated always, but the complicated model would be difficult to make it simpler. Thank you, Sabita Girim. The presentation is very interesting, a lot of questions. There are many unclear things. Any model is sort of a simplification of the reality, which cannot take into account all the options of the policy and all possible changes. Therefore, thank you very much. Our third report, our third presentation, speakers are Jandos Ibraev. He has spoken already today as a moderator. I remind you, he is Deputy Director of the Department of Financial Stability and Research, PhD in economics. His research interests include studying the relationship between monetary policy and financial markets, fiscal policy, macroprudential regulation, and long-term economic growth. Jandos has participated in many conferences, has a number of publications in domestic and foreign scientific journals. His co-author is Serek Rustanov, analyst of the Financial Stability and Research Department. Serek's area of interest includes issues of the corporate sector, its financial conditions, sustainability, corporate lending, and its impact on macroeconomic stability. Serek holds a master's degree in finance from the University of Essex. Colleagues, please, the floor is yours. Thank you very much, Vitaly Alexeyevich. I'd like to say that, as they say, we always understand that our presentation is between you and the lunch, or dinner, sorry. So we will try to be as brief and interesting as possible. Thank you. The lunch has just finished and the dinner is still far away. It's just a phrase, you know. Thank you for this opportunity to speak at this conference. It doesn't allow me to switch back the slides. Please show the first slide. I just want to say that this is a work in progress. It's a research in progress. Your questions, your comments, your criticism and doubts are appreciated, and it will improve our paper. The authors, first author is Serik Rustanov. Bigshan Kondikov is not here. He is from our department too, and Sabit Hakimjanov. This is our research, the author's vision of the real sector of economy of Kazakhstan, deposits of the National Bank. Let us start. The first thing we'd like to say, this is our research question. In this paper, it consists of the large two sub-questions. The first one, review of financial stability of enterprises depending on their financial characteristics. The characteristics like leverage, liquidity, size, age of firms, and others. As soon as we determine stability of financial condition of the firms, we can proceed to the main issue of this research, identification of inefficient companies and econometric assessment of their impact on key macroeconomic indicators. In other words, we would like to research the share of companies who operate even though they have financial technical bankruptcy, and document the main characteristics and impacts of such ineffective companies. If you understand the question of this research, we will answer it, will provide our motivation and references, definition of ineffective companies. So we will speak about the data we use in this research. We will show you the main empirical results we have so far and the conclusions. Briefly, I would like to say about references in this sphere, first of all. And I will repeat that the question is of characteristics of the firms with the corporate sector companies and their interaction with the macroeconomic parameters, specifically in the context of the developing economies. There are not many research papers about it which determine the distress condition of the corporations in the emerging markets economies.
What is important to understand in the literature, we are tracing the economic instability of the firm and the reasons for the bankruptcy. So the disadvantage of the firm is not the lack of understanding how to generate the money. So we have two approaches in the literature that are based on the market approach or accounting-based variables. There are two approaches, and we can see that the firms are stressed if they have, among other factors, higher leverage, lower profitability, lower market capitalization, less cash, and higher market multipliers. This is the introduction into our research. A couple of words about aggregate trends in Kazakhstan, what happens to the corporate debt, what is the structure of debt in million. You can see the absolute numbers in million of dollars in gray and red. This is corporate debt. Gray are government corporate debt, such as bond issuance, and in red, corporate debt in bank lending. So if we look at the household debt, that's in orange, and on the right, we can see that if the debt increases in absolute, in million of dollars, with GDP, it remains at the same level, around 50%. but it actually decreases in middle and long term. The company has less advantage to have a corporate loan. I give the floor to Serik. Thank you, Jandos. Before we look at the motivation, I will look at the Z-score, such as a proxy measure of the financial stability of an enterprise, and also looking at the probability of bankruptcy. The Z-score consists of 4 main components. That's working capital, operating income, obligations, and retained earnings. Altman compares that score to the bond issuance, so it puts it into gray zone and safe zone and distress zone for those companies that are in an unstable position. We can observe that in general, the model can really well identify the bankrupts 2 years before the bankruptcy. That's around 73% of our respondents. Altman notes 72%, but the mistake, the model makes mistakes on our data because non-bankrupt are considered as bankrupt. And observing such results, we made a decision to study this question of non-efficient companies and their influence on the economy. Next slide, please. We can see in the scientific literature that the question on non-efficient companies is studied, and they are looked at as corporate zombies. And the research is done on the companies of separate countries and on the group of countries. Main indicators used for inefficiency determination, we call this zombie companies, these inefficient companies. We have 2 indicators, ICR, that is a coefficient of the operating turnover coverage, and the negative capital as well. These 2 indicators are used if the companies don't cover their expenses in 2 or 3 years. They are considered inefficient. In one case, in another case, they might use the negative capital in 1, 2, or 3 years in a row. So next slide. In general, in the period of 30 years, we can see the dynamics of growth of insufficient companies. We can see such growth being connected to the economic fall. We can observe with an economic fall. The share of these companies grows no matter if they're public or non-public. And with that, the share of inefficient companies is higher. In literature, this is described as insufficient companies leaving the market, and non-public firms are really big. And private companies are not likely to stay on a certain level. We're looking in Turkey for zombie firms, and we can see that this is around 10% during the last years. We use in our research data of the Bureau of the Statistics. They gather statistical information, and we have around 45 respondents. And with that, we know that in total, the legal persons registered by 2024, this is around 560,000 legal entities registered in Kazakhstan. We include companies with assets, with turnover, with profit. And we leave out the companies that are empty, that have empty operational value. So in our research, we have around 9,000 entities left. And this number has grew if we consider it in general. Taking into consideration the literature of other authors, we use two identification of inefficiency. First are the companies that don't have any profit, unprofitable companies that cannot make any profit in 5 years. And second one is that the company exists for 3 years with a negative capital. Those companies that don't match our insufficiency description, they're healthy companies. If they operate within violations for the next 1 year after violation of key and ICR indicators 3 years in a row, they're considered to be healthy. So the share in Kazakhstan actually decreases, and the share of insufficient ones is much, much higher. Then we wanted to present several descriptive graphs, analysis before our empirical assessment. You can see here on the left upper graph that the share of non-profit companies is growing with the number. With the side the same, you can see on the lower graph that it grows, but before 50 billion. The more assets the company has, the more insufficient it might become. On the right upper graph, we noted that the share of insolvent companies or non-profitable before 5 years is the smallest share, less than 5 years. In general, these results, say that such firms have bigger opportunity on restructuring the debt, and the banks themselves, they have the stimuli to support. Here on the next slide, we wanted to show the general structure of the funding that's on the left in two graphs and in shares from the whole choice. These are two graphs on the right. What we can see here, the share of unprofitable liabilities in the total volume of liabilities. Their capital is in green, it's negative. It's the same like in insolvent companies that always have the negative capital. And we wanted to note that the liabilities on solvent companies is focused on the debt, and once there is in general, there is this trend in general, their share decreases for such companies as on the right. Their share in general decreases. What in principle might mean that these insolvent companies use less resources? Thank you. Sirik, the floor is yours. We also did the life cycle analysis of loss-making and insolvent firms. We wanted to show you the efficiency of using the assets. It turns out that from the moment of entering, we identified them for 3 years in a row. We can see that the liability levels decrease, and once they enter the insufficiency state, the company throughout the life cycle remains on average insolvent. So those companies that actually improve their situation, they leave our insufficiency description, and they have the similar dynamics we can see on the coefficient of profitability, but it is not that obvious. Next slide, please. At the present slide, we would like to show the difference between two. You can see on the upper left graph that are in solvent companies. Yes, so those that shouldn't actually cover their interest rates with their profitability, but the companies that have insufficient capital, they cannot cover their interest rates throughout their life cycle. With that, the companies that recover, they improve their activity. Also, that is the asset liabilities. Insolvent, they have negative capital, and we can see that their liabilities overcome the assets. And throughout the life cycle, their leverage increases. And a similar picture can be seen on the non-profitable ones. And with the concluding stage of our research, we do the empirical measurement. With that, we analyze the specification suggested in box on the left, where we have the sales to assets, and we have variable to interest if the company is insufficient, and 0 if it's a healthy one. First regression is in circle. We can see the coefficient, distress coefficient, that insufficient companies have less profit. This is that we confirmed on our econometrical specification. Second thing is that we wanted to show that we actually do the regression, the same regress, and we instead of sales, we use other parameters, financial characteristics, employment, for example. Their coefficients are negative as well. That means that the stress companies create less working places. On the table, in the table on the right, we put investment. We have more or less the same results. That means that distressed or inefficient firms produce less investment. I want to once again repeat, they have less labor opportunity, or they have less working places, less investment generated, so they have a very low rentability. Now we go to the heart of our research, and we do the measurement, the impact of ineffective companies on efficient companies. That actually answers our initial question. We are interested in this specification that is any characteristics, financial characteristics of the firm, working places, profit, cash. On the right, we are interested in alpha 3 coefficient, that's interaction term, that actually gives us the margin in macroeconomic parameters if the share of inefficient companies grows. First thing in alpha 3 is non-distress, that's a healthy company, multiplied by share of the distress, that's what we receive. Main thing that we want to see, this circle, we can see interaction term alpha 3, that is statistically important negative. How do we interpret it? We say that the insufficient companies negatively impact the efficient companies. How? Their share grows, which actually looks at the liability of the healthy companies by 0.905%. That is in both in insufficiency and non-profitability. This is a negative sign, which actually shows that the increase of the share decreases the economic profitability. We look at this regress on the sales to assets, and we receive a similar result. We have actually proved to ourselves, in general, the share of insufficient companies in Kazakhstan is decreasing. The economic potential of the whole economy, but also of the healthy firms, that's going ahead because they're using more and more resources that are in the economy. Serik, the floor is yours.
To summarize our research, we see actually that the share of inefficient companies is decreasing in the last 15 years. These companies are not profitable, they have a high debt burden, they invest less in the fixed assets, their share is growing, while the company's size is increasing. They have bad impact on healthy companies, and they create less jobs. Thank you. We will be happy to answer your questions. Thank you. Shandos and Serik, thank you very much for your presentation. You said it's continuation of the previous one. During the previous conference, you present the first step of this paper. This is a continuation, and it's good when the topic is good, when the research is not finished, not published yet. It continues, it goes deeper. Thank you for this specifically. Now we have a Q&A session, right? Let us start with the questions from the audience. Alisher, do you have a question? Please feel free. Jandos Serik, thank you for your work. Stress testing is a very interesting topic. My question is, in general, about the methodology, because you have an effect of, how you called it, distressed companies. How do they impact sales? At the same time, you define a distressed company as a company which has problems with servicing their debts and liabilities, which depend on sales too. Is there any potential reverse causes? The income we saw on the slides, they do not show real difference between the healthy and distressed companies. It's more visible in the difference of operational revenues. We had more focus. I don't think that the revenues of the company, they depend on the efficacy of the company. If it is not effective, it might have some revenues, but at the stage of the operational profit, they are really different, as we have noticed. I would like just to add that we have studied this phenomena. If a company is non-effective or distressed, it has some profit, some positive income. But at the same time, if we have noted, it might not cover its expenses. That's why its profit will be different. How to control it? Your question about sales is not relevant for the distressed companies. It's not relevant because they do have revenue, but it's not enough to cover their expenses. When we talk about profitability, your question is more suitable, that they have low profitability and then go into distress status, inefficacy, have lower profitability even more, and have more distress status. Here we control all possible regressions and other controls in companies and macroeconomic controls. I think this is the best thing we could do, or if you have any proposal how to control it, please share with us. Not at the moment, but it's quite an interesting question. Thank you. I'd like to clarify something too. I have more technical question. When you divided the companies, you used Altman, as far as I remember, and in this model, the ratios were calculated for the developed economy. You can correct me if I'm wrong, but the question is more, if you plan to strengthen your research and calculate ratios for the emerging economies based on our data or neighboring states. This is my question. We referred to Altman. First of all, it was a model proposed by him for the developing countries. Based on multiple countries, he made some average perception, and we determined the distressed companies based on two metrics: non-profitability, and we did not use this score to assess the inefficiency. You didn't use the Z-score. And you're not going to develop it to recalculate it based on other coefficients to assess it on yours. No, no, we're not planning this. Don't say no. What if? Thank you. Once again, thank you for your presentation. As far as I understand, the main thesis is about influence, impact of zombie companies on the healthy companies is that the linear regresses. Altman related to the percentage of distressed companies, and to healthy companies makes it negative number. And in the calculation of Altman, there other components are taken into account, like liquidity and others. As you said, did you take into account the probability of interaction of these components to the distressed companies component, as you said? I didn't show it in regress, but as a control, all these characteristics are included, like liquidity, financial debt, size, age. They are like control variables, but they are not shown here in the graph. They are perpendicular as a separate component. Okay, thank you. Colleagues, let us discuss the questions on the slide. First comments and then slide questions. It's more comment. Cool. It's an interesting research proposal. Develop the package of proposals for the government, and don't forget about taxes. It's like assessment of the paper and continuation of the work. Do not say no. My Bianca question. She was a participant of the previous conference and she had a fraud presentation. The question is,
identify any specific industries which are subject to a greater probability of financial distress?
Можно на русском, да, ответить?
Can I answer in Russian? Mostly the among the loss-making and failing companies or industries, this is processing industry, agriculture, transport, and warehousing and trade. Mostly processing industry and agriculture to the great extent, if I understand the question correctly. Second question.
Have you compared direct costs of financial distress versus indirect costs?
Accounting variables. This is not direct cost of financial distress, no. Those companies that we consider in financial distress are based on accounting variables. Once we identify them as financial distress, we do further our analysis. But no, we don't use the court fees, for example, not technical bankruptcy.
Thank you. Yulia's question: what is the structure of the sampling you used in this research? Effective, non-effective companies, is it possible that this is the response of both types of companies for the general contractors? the branch structure, if I have it here. As for sampling and zombie number, the dominating one is the processing industry, agriculture and trade. The maximum share among the loss-making companies is the processing industry. The maximum number of loss-making companies is in the processing industry. The maximum among failing companies is the mining industry. Thank you for this question. I think it can be answered like this. Since we have year fixed effects, so we control for variation in time. This is an average effect in 12 years. So if the healthy companies meet the same economic environment as unhealthy companies, then it is controlled in this analysis, in this regression. Indeed, they can comply with the same global trends, but it could be accounted through the fixed effects. It can be an answer, but we need to think it over again. Colleagues, we are out of time. If you don't mind, this is the last presentation. We can answer all the questions. We have a lot of time before dinner. If you don't mind.
Including the COVID-19 crisis, have contributed to the decline of inefficient companies through increased bankruptcies.
Но что касается увеличения банкротств,
as for the increase in bankruptcy, we don't see any growth in the period since 2015. As far as I understand, the number of enterprises at the bankruptcy stage among legal entities is about 3,500, and is not changing at all. We think that increase during the COVID period was not observed with any differences in the share of companies. Some increase is obvious in 2016 to 2017, and the scientific papers explain the growth after the economic decline back in 2016. As far as I know, there was some slowdown in economic growth and high inflation rate in 2016. In 2017, also in 2016, there were some state programs. The measures were taken to support the businesses, and in 2017 we saw an increase in the failing loss-making companies. This could be a kind of result, as we can assume. That's it. Then, according to the studies, the number of loss-making companies is declining. This is evidencing recovery of these companies or liquidation of the loss-making companies. We can only assume, but I think since the main funding of such companies is the financial debt, including the banking debts, and we believe that that decline in 2019 and afterwards was due to strengthening of control to some extent, and supervision we can only assume, and maybe banks and creditors have more strict requirements to the borrowers, their applications. If we can answer this question in the course of our research, we'll try to do our best. It's a good question, actually. We'll keep it in mind. Thank you for your comment. We get additional questions, but I would suggest to have only 2 questions to finish. Otherwise, we would not be able to stop. Did you take into account secondary activity of the company, like using 1 to MFP and other secondary types of activities in the firm. Yes, indeed, we used the total revenues for all types of activity of the company. We did not divide it. We did not divide the primary or secondary types of activities. We did not separate them. And the last question from Kwanish. In the company OSD, the share of zombie companies is growing. Does it characterize somehow positively our country in this respect? We have different horizons. First of all, in OECD countries, they have a horizon of 30 years, and we have available data only since 2010, which we could analyze. And reduction, we cannot explain it precisely. We cannot say what it is connected with in terms of decline. Colleagues, herewith I would like to stop our questions. Thank you to our speakers, to everyone who took part in this research. And I will repeat, I hope this is just the beginning of such kind of research, and you will continue. I agree, you are just starting. You are at the very start. Alisher, I think you have further opportunities to work. We have 30 minutes for coffee and discussion of the questions, so we have not finished. Let me provide you with the final words. Dear colleagues, our interesting discussion has come to an end. The topics of today's conference were based on the relevant issues of monetary policy, financial stability, and economic development prospects. The first session featured research on the monetary policies of Kazakhstan, Azerbaijan, and Uzbekistan. Central bank researchers shared their findings that monetary policy is becoming increasingly complex and requires adaptability, and show that both internal and external factors need to be taken into account when making forecasts and decisions on monetary policy. Just as the economy is affected by external and internal shocks, so consumers react to changes in current conditions. In the second session, we were introduced the results of consumer behavior studies, where it can be noted that the first thing consumers give up is services and expensive goods. However, as our speakers noted, consumption quickly recovers when economic conditions normalize. In the third session, we looked at how Kazakhstan's economy reacts to price shocks and structural imbalances, and saw that the economy needs structural stability and efficient resource allocation. It was noted that oil shocks are a key factor influencing Kazakhstan's macroeconomic stability. At the inter-firm level, researchers showed that inefficient firms negatively affect the performance of healthy companies. That makes me sad, but it's good that their number is declining. We strive to ensure that scientific results, ideas, comments, and recommendations are of the implied nature and serve as a basis for future research. Details of the studies that have aroused your particular interest can be found in a special issue of our official publication of the National Bank Economic Review, in which we will traditionally publish, with the permission of the authors, the papers presented at the conference. It will include articles or abstracts of the studies present today. This issue will be posted on the website of the National Bank of Kazakhstan, the relevant section, maybe in 3 months, not that fast, I hope so. There are some technical and bureaucratic issues. Friends, I'd like to draw your attention to the fact that there is a final coffee break, and we can finalize all the issues we have not managed to discuss yet. Thank you to all speakers, participants, organizers, technical team for this great conference, and see you at the next scientific and practical conference, I hope in 1 year. Thank you.